Hello everyone, my name is Nitin Nahar. I welcome you all on behalf of JK Shah classes to this amendment video for May 2025. As I am recording this, till now the statutory update for May 25 is not released, but all these amendments are based on the new ICI modules which are released for May 25. The description of this video has the PDF, and if there is any additional change based on statutory update, a separate video will be released for the same. So with this brief, let's now start with the amendments. So there have been quite a few amendments, but all those are clarificatory in nature, except for some few changes like arbitral tribunal provisions have been modified, and then refund provisions have been made easy, and a particular refund point also has been added. Otherwise, majorly it is circulars which have been introduced, and as you understand, circulars are basically clarifications issued by CBIC to provide us better clarity on the provisions. So let's have a look at the clarifications. Now the first one is related to ESOP. Now what generally happens? Say suppose there's a company Amazon India. Now there are some employees in Amazon India. As part of the package, that is their salary, Amazon employees will get ESOPs. Now these ESOPs which Amazon India employees get will be of Amazon US. So employees receiving ESOPs of Amazon US. Now obviously the Indian entity will do a reimbursement to the US entity for the shares which are allotted of the US entity to the employees of the Indian entity. Now the question was that the payment which is made by Amazon India to Amazon US for those ESOPs, whether GST would be applicable, and in essence can ESOPs be made liable to GST. Now CBIC has clarified that if this reimbursement is on cost to cost basis, then in that case there would be no GST implication on this. But in case any additional markup is being charged, then that additional markup will be liable to GST. Otherwise, there is no GST anyways. Plus, what about the ESOPs which are given to the employees? That is anyways employee providing service in the course of his employment to the employer, and hence this ESOP is anyways covered by negative list. The primary question was relating to the reimbursement or the money transferred from Amazon India to Amazon US. That particular amount, will it be liable to GST? No, if it is on cost to cost basis, not liable. If any additional markup is being charged, then in that case it is a service from Amazon US to Amazon India, and Amazon India will have to pay taxes under reverse charge mechanism. This is the first circular. Now you might get a question on this part or also on this part. The treatment of it will be zero, but you will need to be careful about the provisions. Let's have a look at the circular. Circular 213, clarifications on taxabilities of ESOP, ESPP, restricted stock units provided by overseas holding company. Companies offer employee stock purchase plan, employee stock option plan, and restricted stock units to employees as part of their compensation package. Questions arise regarding applicability of GST when such securities are issued by the foreign holding companies to the employees of its domestic subsidiary. So, Amazon US stock is being allocated to the employees of the domestic subsidiary. No GST is applicable when a foreign holding company issues ESOP, ESPP or RSU to the employees of the domestic subsidiary, and the domestic subsidiary reimburses the cost of the securities on cost to cost basis. However, if the foreign holding company charges any additional amount over the cost of the securities, GST is leviable on this additional amount. And the supplier is Amazon US. So domestic subsidiary must pay GST on reverse charge basis of import of services in such cases. Okay, let's go to the second one. This is about salvage or rec value. See, how does the transaction happen? Let's understand. Now, insurance companies basically provide coverage. They provide coverage saying that in case there is any loss or damage to the vehicle, we will provide a reimbursement. Now, in these cases, when a reimbursement is provided, the question was that, say suppose insurance company is paying 50,000 rupees as insurance claim. Now, when they are providing 50,000 rupees as insurance claim, sometimes the company will deduct 2,000 rupees as salvage, and then that salvage, the leftover parts, will become the property of the insured. So insured is getting 2,000 rupees as salvage value based on the agreement, and 48,000 is being paid by the insurance company. Now here salvage is property of the insured. So the question was whether on this salvage GST will be required to be paid by the insurance company. CBIC has clarified that there is no GST on this salvage because it is the property of the insured and it will be sold by the insured, and hence GST will not be applicable. But case 2 where insurance company pays insurance claim of 50,000 completely, and then salvage or wreck becomes property of insurance company. Now if it becomes the property of insurance company, then the insurance company sells salvage. Now when they are selling this salvage, whether GST will be applicable? The answer is yes. When insurance company sells this salvage, GST is applicable. So the basic distinction is whether the property is there a compulsory deductible item? If as per agreement, then in that case it is property of the insured, then GST will not be applicable on this in the hands of insurance company. But say suppose the insurance company pays entire 50,000 and salvage is property of the insurance company and then they sell it, then in that case GST would be applicable. Let's have a look at the circular. Clarification on taxability of salvage or wreck value in motor vehicle insurance. Whether the insurance company is liable to pay GST on the salvage or wreckage value earmarked in claim assessment of damage caused to a motor vehicle. Clarification. Insurance company provide the service of insuring vehicles and compensate the insured for damages according to the terms of insurance contract. The GST liability on salvage or wreck value depends on the ownership of the salvage. If the value of salvage is deducted as deductible from the claim amount and it is as per the contract terms, the salvage remains property of the insured and the insurance company is not liable to discharge GST on it. If the claim is settled in full without deduction of salvage or wreckage, the salvage becomes the property of the insurance company and insurance company must discharge GST on supply of salvage to the salvage buyer, because then insurance company is making the sale, hence it would be liable. Now what I recommend is there are some spaces which are available in the pages. I would recommend you to write all this here, and while you are writing you will be able to understand it very quickly when you are reading it next time. Because what is the most essential aspect? When you read something next time, you should be able to read it quickly so that you can go prepared for your examination. Okay, now let's understand the third one. Now this is again on loans which are given by related person. See, when a related party gives a loan, so A and B, this is A limited, this is B limited, these are related persons. Now it may so happen that a loan is given by A limited to B limited. Normally there is no processing charges etc. which is charged between related person. In fact, even on other loans which are given other than by banks and financial institution, processing charges are not levied. The question was, when the loan is given, whether GST can apply on processing charges which would have been paid if the loan was taken from a bank. Because what the law says, section 15 says, if it is a transaction between related persons, then transaction value will not be accepted, and if transaction value is not accepted, then you go to the valuation rules. When you go to the valuation rules, rule 28 talks about related person transactions, and it says that the value will be open market value. And tell me one thing, do bank normally charge processing fee? The answer is yes, banks normally charge processing fee. So as it's a related person transaction, officers were taking a position that transaction value will not be accepted because they used to just charge interest, and as you know, interest is a exempt supply. Now officers used to take a position that, see, the transaction is between related person, as the transaction is between related person, we will not accept that interest which you are charging. Then we will go to the valuation rules, we will apply rule 28, we will apply open market value, and whatever bank is charging as processing fee, that is a supply between A limited and B limited, GST has to be charged on that. That was the position taken by officers. Now CBIC has clarified that if only interest is being charged between related persons, then in that case it will be exempt. You cannot add any processing fee. However, if additional amount charged as processing fee, then GST applicable. But if no processing fee is charged and only interest is being charged, then in that case it will enjoy an exemption. There will not be a notional inclusion of a processing fee or charge. A very good circular given by CBIC. Plus, say suppose A Limited is in US and B Limited is in India. Same treatment will apply, because even in this case B Limited is not required to pay tax under reverse charge mechanism because interest is exempt. If any additional amount is charged, then in this case GST will be applicable, and if the supplier is outside India, recipient is in India, place of supply is in India, then it will become an import of service and recipient will have to pay tax under reverse charge mechanism. Let's have a look at the circular. Clarification regarding taxability of loan transaction between related persons under GST. Whether the activity of providing loan by overseas affiliate to its Indian affiliate or by a person to a related person, where there is no consideration in the form of processing fee, admin charges, loan granting charges, and consideration is represented by only interest or discount, then will it be treated as a taxable supply under GST? Let's see. No additional charges beyond interest and discount. If no consideration is charged by related person or overseas affiliate other than interest or discount for extending the loan or credit, it is not considered as a supply of service under GST. Therefore, no GST levy by resorting to open market value under Rule 28. Officers were very smart. They were always going towards Rule 28, saying that because related person, so you are not charging processing fee. We will take the comparable of a bank. 1% or 2% is the processing fee. On that, please discharge GST. Now, if the loan is with additional charge, if any processing charge, administrative charge, service fee or loan granting fee is charged in addition to the interest or discount, it is considered as consideration for the supply of services relating to processing, facilitating, administering the loan. Such supply will be liable to GST as supply of service by the lender to the related party. So, these are the three circulars relating to supply. Now, let's move forward to the second one. This is some clarifications relating to time of supply and place of supply. The first clarification is relating to hybrid annuity model contracts. Now, what happens in this hybrid annuity model contracts? See, all these national highway contracts are on hybrid annuity model. After achieving every milestone, government makes some payment to the contractors who have made those roads. So they get two payments. They get one payment from government and the second one is obviously toll charges. So when you talk about the payment which is being made by government on achieving each milestone, the question was, what would be the time of supply in such hybrid annuity models? Because the contract will specify 3 milestones. The moment these 3 milestones are achieved, some payments will be made. Maybe 30% would be made here, another 40% would be made here, and balance 30% would be made while the last milestone is completed. The question was, how do we derive the time of supply for this? Now, if you see, all these hybrid annuity models are for a period more than 3 months. Plus, there is always an obligation to make a periodical payment, which you can see on the screen. You can see that these periodical payments are required to be made after completion of each milestone. Then CBIC has clarified that this is a case of continuous supply of service. And as it is a case of continuous supply of service, if you recall, there are three parts of continuous supply of service. You will check invoice date, payment date, or due date to issue invoice. Now, due date to issue invoice can be based on three things. One, if the payment date is ascertainable from the contract. If it is ascertainable from the contract, then in that case, the due date to issue will be date mentioned in the contract. If it is not ascertainable, then in that case we use date of receipt of payment. And if it is based on completion of an event, then it will be completion of each event. Now, say suppose this particular event got completed on 5/6. Completion of an event. I issued the invoice on 6/6. Payment was received on 7/6. What would be the time of supply? CBIC has said that as it is a case of continuous supply of service, as it is based on completion, 5/6 will be the time of supply. But what if I have issued the invoice before this on 1/6 itself? If I have issued the invoice on 1/6 itself, then the time of supply will be date of invoice, because basically we are just trying to apply the provisions of continuous supply of service. So the clarification clearly provides that whenever it is a case of continuous supply of service, what is to be checked is invoice date, payment date, or due date to issue invoice. Let's have a look at the provisions. Circular number 221, clarification on time of supply for services under hybrid annuity model contracts. Issue. In hybrid annuity model contract for construction and maintenance of national highway by NHAI, which involves staggered payments over time, how is time of supply determined for GST purposes? Under HAM contract, which involves continuous supply of service, the time of supply for both construction and operation and maintenance service is determined as follows. If invoice is issued on or before the specified date or completion of an event. Now, if you issue the invoice before the specified date or completion of event, time of supply will be earlier of issuance of invoice or receipt of payment. And normally government contracts, payment happens later. So can there be interest component also, sir? Yeah, there can be an interest component also. So whether that interest component will also be liable to GST? Yes, you know section 15, that interest on delayed payment of taxable supply forms part of value, because if the underlying supply is taxable, then in that case interest is also taxable. Okay. If invoice is not issued on or before the specified date, then the time of supply will be date of provision, earlier of date of provision of service or date of receipt of payment. Further, the installments or annuities paid by NHAI to the concessionaire, concessionaire is the contractor, include an interest component. This interest is includable in the taxable value for GST purposes as per section 15. Okay. Now, let's talk about spectrum. Now, what happens in case of spectrum? See, allocation of spectrum is done by government to various telecom operators. Now when spectrum is allocated, again it's a case where payments are agreed to be made at periodic or regular intervals. Again the question was, what would be the time of supply for spectrum payments which are due on a particular date? See, here the speciality of spectrum payments is it will be due on a particular date which is mentioned in the agreement beforehand. So payment date is ascertainable from the contract. Now if payment date is ascertainable from the contract, again spectrum allocation is for more than 3 months, periodical payment, and payment date is ascertainable from the contract, then the time of supply for this will be, again depending on continuous supply of service, invoice date, payment date or due date to issue invoice, and here as it is ascertainable, whatever is mentioned in the contract. So if you issue the invoice by that date, then such date. If you don't issue the invoice by that date, then the date fixed in the agreement, that would be regarded as time of supply. So same principle, it's just that it is being applied in two different concepts. For hybrid annuity model, you are using completion method because there it depends on the completion, it's not a fixed date. But in spectrum it is a fixed date, so you'll go by the contract or invoice or payment, whichever is earlier. Let's have a look at this clarification on time of supply for spectrum usage and similar services. For spectrum allocation services under GST, where the payment is either made upfront or in installments, how will time of supply be determined? Let's see the clarification. The time of supply for spectrum service under the spectrum allocation model followed by Department of Telecommunication, the telecom operator may choose to make payment either in lump sum or in installment. Sir, what if they pay in lump sum? If they pay in lump sum, then whenever the payment is made, that would be regarded as time of supply. Then in that case it is not a continuous supply of service, because one important condition of continuous supply of service is periodical payments. If the payments are made in installment, it constitutes a continuous supply of service as per section 233 of CGST Act. The invoice for such services must be issued on or before the due date of payment as specified in the contract, which is ascertainable from the frequency assignment letter. Upfront versus deferred payment. For full upfront payment, GST is payable when the payment is made or due, whichever is earlier. For deferred payments made in installment, GST is payable as and when each installment is due, or is it made, whichever is earlier. So you'll basically use the continuous supply of service provisions. Will the same treatment apply to other natural resources which are allocated by government? The answer is yes. CBIC has clarified that whatever we have said here will apply to other natural resources also, because if upfront payment is received, then directly you will use that date or date of invoice or date of payment. If it is installment, then it is a continuous supply of service, and in continuous supply of service you use date of invoice or date of receipt of payment or due date to issue invoice. And due date to issue invoice, you very well know, when the payment date is ascertainable, we use such payment date mentioned in the contract. Okay. This treatment also applies to other scenarios where the government allocates natural resources to bidders for a right to use over time, constituting a continuous supply of service with options of upfront and deferred payments. Okay, now let's have a look at another circular relating to place of supply. Now this circular relating to place of supply is quite interesting. It's an application of 10(1)B versus 10(1)CA. Let me first show you the example. Say suppose there is a supplier in Delhi and there is a person in Delhi who orders the goods. And this person in Delhi who orders the goods is an unregistered person. So the invoice is being issued to this unregistered person. But the goods are getting delivered to Mr. C, who is in Karnataka. Now the question is, maybe he is sending as a gift or some other transaction where C is actually receiving the goods. Now the question arises is, what would be the place of supply for this transaction? Now, if you apply the provisions of 10(1)B, then it's a clear case of principal place of business of the third person on whose direction the goods were delivered to the recipient or any other person. So if it is 10(1)B, then the place of supply will be Delhi. There is no doubt about it. Now 10(1)CA. If you see, 10(1)CA deals with supply to unregistered person. And 10(1)CA, supply to unregistered person, says if the address of recipient is available on record of the supplier, then such address will be the place of supply. If there is no address available on the record of the supplier, then it would be location of supplier. This is the law. This is how the law reads. Now, as the supply is being made to unregistered person, will you apply 10(1)B or 10(1)CA? See, let's first make one thing clear. If it was supplied to registered person in bill to ship to, you will go by Delhi. There is no other alternative available. No alternate answer if the supply was to a registered recipient. The only problem is when it is provided to an unregistered person, because there are two provisions. Though let me tell you, 10(1)CA does not override 10(1)B. It overrides only 10(1)A and 10(1)C. So the question is obviously what needs to be done in this case. Plus, if 10(1)CA was to apply, CBIC has said 10(1)CA to apply. Now, which address do we use? Because we have two addresses. And another interesting point, recipient is the person liable to pay, which is Delhi. But if you see, technically the goods are getting consumed in Karnataka. So consumption is happening in Karnataka. As per consumption principles, it should be Karnataka. But as per the crude understanding of the law and clear understanding of the law, it should be Delhi. Now, what CBIC has said is, in this case, the place of supply will be where the goods are getting delivered, and address of delivery of goods will be regarded as place of supply. See, I personally don't agree with this circular, but me agreeing or not agreeing doesn't matter. What matters is what has been told by CBIC and what we need to write in the examination. And hence, delivery address will be used as place of supply. Plus, CBIC has also given instruction to the supplier saying that Supplier should record the address of delivery as supplier should record this as location of recipient or address of recipient. Now the moment CBIC is giving a direction that the address of recipient should be where it is delivered, then obviously such address would mean Karnataka and the place of supply will be Karnataka. Very important circular from examination point of view, because institute will try to give you this in the case study based MCQ, or they might give it to you in the main question, which is first question of the examination, where they will give you this scenario. Now if you take the place of supply as Delhi, you will end up charging C plus S because supplier is in Delhi. If you take it as Karnataka, then you will end up charging IGST. And as this circular is related to unregistered person, ICI might also give you registered person case. Don't start applying this circular in registered person cases also. This circular is only for cases of unregistered person, when the supply is made to unregistered person and by e-commerce operator. So on the platform, I mean, when I say by here, I mean on the e-commerce platform, then in that case the supplier has to record the delivery address as address of recipient and the place of supply will be address of recipient. So to conclude, if supply is to registered person, apply 10(1)(b) without any problem. Go ahead, make a answer. If it is 10(1)(ca), supply to unregistered person, then address becomes the place of supply, and CBIC has said address of delivery will be regarded as address of recipient, and hence the place of supply will be where the goods are being delivered. Okay, mark it as very important for exam. Would recommend you to write this as well. Let's now have a look at the clarification. Clarification relating to place of supply in case of 10(1)(c). Mr. A, an unregistered person, orders mobile phone from an e-commerce platform. Careful. The billing address is state X. In our case, billing address was Delhi. And the delivery address is state Y. In our case, Bangalore. Karnataka. And please see this unregistered person very carefully. Mark and keep. What would be the place of supply for this transaction? State X, that is billing address, or state Y, that is delivery address. Clarification. Place of supply determination. In cases where the delivery address differs from the billing address, the place of supply for goods will be the address of delivery recorded on the invoice. Therefore, for the given scenario, the place of supply is state Y, where the mobile phone is delivered. Invoice detail. For transactions involving goods to unregistered person with a different billing and delivery address, supplier should record. See the instruction to supplier. Supplier should record delivery address as address of the recipient on the invoice for determination of place of supply. So when CBIC itself says that delivery address will be the address of recipient, then obviously that delivery address will be used as place of supply. Okay, then the next one is relating to FPIs, banks providing services to foreign portfolio investors. Now what is this, sir? See, custodial services are provided because FPIs are located outside India. So they hold securities in Indian markets. They hold various positions of derivatives, securities, various other things are held by foreign portfolio investors. As they are outside India, the banks act as custodians for all these assets which are held by FPIs. Now, custodial services being provided by Indian bank to a foreign portfolio investor who is outside India. The question was, what will be the place of supply? To give you a background, if it is 13.8, then the place of supply will be location of supplier, and supplier in this case is India, Indian bank. Then the place of supply will be in India. Now, if it is not 13.8, then it will fall under 13.2. 13.2, location of recipient will be used. Now, banks are providing these services to foreign portfolio investors. The question is 13.8 or 13.2. Now, what's the implication? If you take 13.8, it will be a transaction liable to GST. You will not get export benefit. But if you call it as 13.2, then in that case GST would be not applicable, because it will qualify as export, because you receive foreign currency for this transaction and place of supply will be outside India. So what do you think? Obviously, CBIC has clarified that it is not 13.8, because 13.8 only covers services by banks to account holders, and account is where something is bearing interest, and that's why it is not bank to account holders. As it is not bank to account holders, it will not be a case of 13.8, it will be a case of 13.2. Good relief to the banks. Let's have a look. Whether place of supply for custodial services provided by banks to foreign portfolio investors is covered by 13.8 or determined by the default rule. Clarification. Custodial services provided by banks or financial institutions to FPIs are not treated as service provided to account holders under 13.8a. The place of supply for these services should be determined by the default rule, that is 13.2. And you can write the implication is that if forex is received, it will be regarded as a export of service, implying that there will not be GST because it becomes an export of service, which is a zero rated supply. Okay. Next clarification is also on the same lines. This is advertising service provided to foreign clients. Now see what happens. Sometimes foreign clients wants to advertise in India. Now when foreign clients wants to advertise in India, they will contact the advertising agency in India. Now this advertising agency in India is the supplier. What they will do is they will arrange everything. They will do end-to-end work. They are not just intermediaries. What they will do is they will talk to the media house. They will get a slot allotted. They will do the paperwork. They will get everything executed. They will make sure that there are no gaps. They will make sure that the service is being provided as requested by the foreign client. So overall, the entire advertising concept is being taken into consideration. He is not just an agent who is saying that media house, this is the address, foreign client, this is the media house where you can do advertisement, talk to them directly, get it done. It's not like that. It's full package which the advertising agency is providing to foreign clients. So the question was whether it is 13.8, that is intermediary, or it is 13.2, that is location of recipient general. 13.8, 13.2. And one more thing is written here saying that is it 13.3 performance based service? I mean, how can it be performance based service? Not at all. Is there some goods which is made available to the from the recipient and supplier is doing a process on that? The answer is no. That anyways is ruled out. But though CBIC has said that is also ruled out. Finally, the answer given in the law is it's not a case of 13.8. It's not performance based service, that is 13.3. It is to be dealt by the general rule 13.2, location of the recipient, and hence in this case place of supply will be outside India, and if place of supply is outside India it will qualify to be export. You will start getting export benefits if foreign currency is received or INR as permitted by RBI, which is there in your refund chapter. Okay, let's have a look. Indian advertising companies working with foreign clients have encountered challenges regarding place of supply being deemed within India, which impacts their export benefits. So officers used to say that place of supply is in India because advertisement is being displayed in India to Indian consumers, so place of supply should be India. The key issue are whether these companies qualify to be intermediaries under IGST Act and whether the foreign client's representative or target audience is India is the recipient. Is the target audience in India the recipient or foreign company is the recipient? Obviously foreign company, because who is liable to pay? Foreign company. Foreign company is the recipient because they are liable to pay for this particular transaction. And if advertisement services are considered as performance based services under IGST Act. Clarification: the advertising company is not an intermediary as it provides services directly to the foreign client and acts on its own account. It's not just facilitating or arranging. Yes, if they would have facilitated or arranged, then they would have been intermediary, but here everything is being done by the advertising agency. The foreign client is not the foreign client and not the target audience or representative in India is the recipient of service. Advertising services are not performance based as they do not require physical presence of goods. Consequently, under the default provision of 13.2, the place of supply is location of the foreign client making the service an export. However, if the company only facilitates media space provision and the contract is between media owner and foreign client, then the company would be an intermediary and the place of supply would then be location of the supplier. Okay. Last circular for place of supply. This is also interesting. Data hosting services. Now, there are Indian companies which provide this data hosting services. So these Indian companies provide data hosting to cloud computing companies which are located outside India. These are the cloud computing companies. Now the question is the data hosting service which is being provided. Is it in the form of intermediary? No, these are full-fledged services. I mean, this involves technology, platform. I am not only an agent in this case. I am providing the technology, I am providing the platform, I am providing them the space, I am providing them everything. And it is not just relating to immobile property. No. Now, what officers used to say data hosting, the data is being managed in an immobile property, so use 13.3 location of immobile property where the property is intended to be located, or use 13.8 intermediary. They just wanted to bring the place of supply in India so that GST can be applied on all the transactions and denying export benefit. Finally, CBIC has clarified that data hosting services is not an intermediary because I am the supplier. It's not intermediary. I'm providing it on my own account. I'm not just arranging and facilitating. Plus, it is not renting of immobile property. I have not just given a space on rent. I have to manage the server. I have to manage all the uh, lines. I have to manage the electricity supply there. I have to make sure that the cooling is good because there's a requirement of cooling in these data hosting centers. If it's not cooled, then in that case it will just erupt and the data would be lost. Plus backup is arranged. So there are so many services which are involved in that. It cannot be regarded as renting of immobile property, and hence the place of supply will be as per 13.2, that is general rule, location of the recipient. So will I be eligible for refund? The answer is yes, if as it qualifies to be export, plus if foreign currency is received, then I will get a refund of taxes paid on purchases because I am involved in export of service. Let's have a look. Queries have been raised regarding place of supply for data hosting services provided by Indian service provider to cloud computing providers located outside India. The primary concern include whether the services qualify as export or if the benefits of export are denied, and whether the service fall under the category of intermediary or related to goods made available by recipient or are associated with immobile property. Clarifications indicate that data hosting service providers are not considered as intermediaries since they deliver services directly to the cloud computing provider without interacting with the end user. These services are not related to goods made available by the recipient or to immobile property. As such, under section 13.2, the place of supply is location of the recipient outside India. Therefore, data hosting services qualify as export provided they meet other conditions outlined in 2.6. 2.6 basically deals with export of service definition under IGST Act. Yes. Okay. Now let's move on to the changes which have happened in valuation. So last time government had added a proviso under Rule 28, and that proviso under Rule 28 said that the valuation for corporate guarantee would be 1% of guaranteed amount or actual consideration charged, and then the law said whichever is higher. This is what was kept as the valuation for corporate guarantee. Now there were a lot of issues being faced in this. The question was, this 1% needs to be seen every month, every half year, every year, in a decade once, because sometimes the loan duration is more than 1 year. So what would be the frequency of this 1%? That was one of the issues. Now CBIC, before coming up with a clarification, the law was amended saying that it would be 1% of the guaranteed amount per annum. So one change is per annum is being added. That means 1% needs to be paid every year. Second change is the issue was regarding recipient outside India. What if there is a holding company in India and subsidiary is outside India, and holding company in India is providing guarantee for a loan taken by the subsidiary which is outside India, whether that would be covered under Rule 28. Now government has clearly said that this will apply only when recipient is in India. See, supplier can be in India or outside India, but the recipient of that loan, the person who is taking that loan, the person who is taking this service of guarantee, the recipient should be in India. Only then this transaction will trigger. Then for this entire thing, if full ITC can be taken by recipient, then invoice value, that is value declared on the invoice, is deemed to be open market value. Now this point was not applicable in the last proviso, but now they have added it for corporate guarantee also, that in case the recipient can avail full ITC, then whatever is the value, that will be accepted. That also means that even if it is nil, that nil will be accepted. So it's a very welcome change. Otherwise the companies were facing a lot of issue, and hence totally there are three changes. One, this per annum point added. Second, it will apply only when recipient is in India. And third, if recipient can avail full ITC, then value declared on the invoice will be deemed to be open market value. Then CBIC came up with a fresh circular clarifying various points, saying that if two companies are giving guarantee to one company, two companies giving guarantee to one company, whether this 1% to be calculated for both or separately. So if the loan is 100 crore, then say suppose one company is guaranteeing 60 crore, one company is guaranteeing 40 crore, then in that case it will be proportionate, 60 crore into 1% and 40 crore into 1%. So whatever is the guaranteed amount, on that you have to apply 1%. So if the total guarantee consideration is charged, that will also be compared in this ratio, 60:40, that is 3:2. That was one clarification. Then the law has also clarified, saying that when we say guaranteed amount, it has to be guaranteed amount into 1%. It will not be the loan dispersed. It doesn't matter out of 100 crore how much of loan has actually been taken. That is completely out of question. What we need to see is 1% of the guaranteed amount. Then again and again CBIC has kept on repeating that if full ITC can be taken by recipient, value declared on the invoice is deemed to be open market value. What if the person who is giving the guarantee, supplier, is outside India? Then in that case reverse charge mechanism will apply. Recipient in India will have to pay the tax under RCM. But again government has said that if full ITC can be taken by such recipients on this service, then value declared on the invoice is deemed to be open market value. So very important for your examination. They might ask you a question on this. Let's have a look at the provision. Rule 28, Valuation of corporate guarantees. The value of supply of services by a supplier to recipient who is a related person located in India, by way of providing corporate guarantee to any banking company or financial institution on behalf of the said recipient, shall be deemed to be 1% of the amount of such guarantee offered per annum. or actual consideration, whichever is higher. Further, a proviso has been inserted after sub-rule 2 to lay down that where the recipient is eligible for full ITC, the value declared in the invoice shall be deemed to be the value of the supply of service. So this is a good change, that a full ITC can be taken. Value declared on the invoice will be deemed to be value of service. Then circular number 225, clarifications on taxability and valuation of corporate guarantee between related persons. First, valuation of corporate guarantee is issued prior to 26 October 2023 when this rule was amended. That will be governed by the previous rule, and only post this will be applicable. So should we remember this date, sir? Not required. They will give you the question of current period only. Then valuation and ITC of corporate guarantee. The value of corporate guarantee is based on the amount guaranteed and not on the loan dispersed. Careful, amount guaranteed. Recipient can avail ITC of guaranteed service irrespective of loan amount or timing of disbursement. Doesn't matter when the loan was dispersed, you can avail ITC. Takeover of existing loans. When a loan is taken over by another institution, one bank selling the loan to another bank, should we again pay? No, because you have already paid. It does not constitute a new corporate guarantee and does not impact GST unless a new guarantee is issued or existing one is renewed. Then corporate guarantee by multiple related entities. The value of guarantee provided by multiple entities is the sum of actual consideration paid if it exceeds 1% of the guaranteed amount. If it is less than 1%, GST is payable proportionately on 1% of the guaranteed amount. So whenever you are checking actual consideration paid, you will check for all the entities together and then compare it with 1%. So say suppose the guaranteed amount is 100 crore. 100 crore, 1%, 1 crore should be the guarantee. Now, if one company is charging 75 lakh and another company is charging 45 lakh, then the total of this 75 lakh and 45 lakh comes to 1.2 crores. Now which is higher? 1.2 crore is higher. So CBIC has said 1.2 crore or 1 crore, whichever is higher. So all the guarantees by multiple entities will be considered together. And if 1.2 crore was lower, then this 1 crore will be the actual one. Then 1% of whatever they have given as guarantee. Payment of tax for intra-group corporate guarantee. If it's a domestic guarantee, then it will be under forward charge. If it's a foreign guarantee by a foreign entity to Indian related entity, then GST is payable under reverse charge by the Indian recipient. When full ITC is available, value declared on the invoice will be deemed to be value of supply. Corporate guarantee where recipient is located outside India. Now what if recipient is located outside India? This rule will not apply. The provisions of 28(2) do not apply if the recipient of corporate guarantee is located outside India. Okay, frequency and amount of tax. Fixed term guarantees, tax will be calculated at 1% per annum of the guaranteed amount or actual consideration, whichever is higher, and is payable at the time of issuance. Careful, at the time of issuance. Very important statement made, because if I give a 5-year guarantee today, it's not that I will be paying 1% every year. It says 1% per annum will be the calculation. If I give a 5-year guarantee, say suppose I give a 5-year guarantee, then 5% into 100 crore, 5 crore, it is payable at the time of issuance of guarantee. Sir, then in that case we will give yearly guarantee only. If you keep giving yearly guarantee, then 1% whenever you give the guarantee. Proportionate valuation. For guarantees less than 1 year, GST is proportionate. For example, 0.5% for 6 months. Renewals. For annual guarantee, GST is payable each year based on 1% of the amount or actual consideration, whichever is higher. That is obvious. Okay. Then the next circular is quite simple. It talks about import of service from a related person. Say suppose I get a service from outside India and I am eligible to take full ITC. Then in that case, whatever I declare as the value, because remember one thing, where is the supplier? Supplier is outside India. He is providing a service to me. Where am I? I am in India. So supplier is outside India, recipient is in India. Who will raise the invoice? Recipient in India will raise the invoice. The invoice which I raise, if I mention the value as 10 rupees, then GST is payable on that 10 rupees. Sir, say suppose I don't raise an invoice, then government has said, if I don't raise the invoice, the value will be nil. But for both these, one condition needs to be satisfied. This is applicable only when full ITC can be availed by a recipient in India. Because this provision will apply only when recipient in India can take full ITC. Invoice, whatever you declare on the invoice is deemed to be open market value, and that will be the value of supply. If no invoice is raised, nil. So this is similar to what was done for HO and branch. It's just that there was a circular on head office and branch office, services provided by head office and branch office. On similar lines, government has given this, saying that if full ITC can be taken even if you have not issued an invoice, nil is the value. Let's have a look. Clarification on valuation of supply of import of services by related person where recipient is eligible to avail full ITC. What will be the value of supply for import of service by related person where full ITC can be availed by recipient? The clarification issued via Circular 199. Circular 199 was HO and branch. Regarding supply of service between distinct person where full ITC is available to the recipient also applies to import of service between related person. For import of services by registered person in India from a related person outside India, tax is payable by the registered person under reverse charge mechanism. The registered person must issue a self-invoice under section 31 and pay the taxes under RCM. When the foreign affiliate provides services to related domestic entity and full ITC is available, the value declared in the invoice by the domestic company, because who is going to issue the invoice? Domestic company, may be deemed to be open market value as per Rule 28(1). If no invoice is issued by related domestic entity, the value of such service may be deemed as nil and deemed as open market value. So then in that case, nil will be regarded as the value of that service. Okay. Now coming to one Rule 32 point. This rule comes from a rate notification. Now ICI notifications always used to say that rate notifications are not applicable for examination, but that rate notification also provides one valuation for old and used vehicles. Now the issue was whether this is covered in syllabus or not. ICI module clearly covers this, and that's why I have included it here. You will read this for your examination. Now what happens in case of old and used vehicles. See, there are different rates prescribed. See, old and used vehicles, if it is sold in personal capacity, then in that case no GST, because it is not in the course or furtherance of business. If it is a business asset, then in that case what will be the value? See, if it's a business asset, there can be three cases. One, no ITC availed on motor vehicle. If I have not availed any ITC on motor vehicle, then in that case value will be sale price minus depreciated value under section 32 of Income Tax Act 1961. So you have to pay on sale price minus depreciated value under Income Tax Act 1961. Plus, if it is negative, then obviously it will be 0. That you are anyways aware. This is based on margin scheme. So what we are applying is margin scheme, sale price minus depreciated value under section 32. This is when no ITC is availed on motor vehicle. Say suppose sir, I have availed ITC on motor vehicle. If ITC is availed on motor vehicle, then you have already taken the benefit, like tempo, truck, you have already taken the benefit. Then in that case, whatever is the sale price, on that you will have to discharge GST. Basically, you are trying to apply transaction value. This is what you are trying to apply. So if you don't take ITC, then in that case, sale price minus depreciated value. Sale price minus depreciated value. If you have availed ITC, then you go by sale price. What if it is any other asset other than used vehicles? Then you just apply sale price minus purchase price, which is anyways done by margin scheme, which is clearly given in the rule, that is rule 32. So motor vehicle, ITC availed or not availed, this has to be checked. Any other asset, directly sale price minus purchase price. Clear with this? Yes? Okay. Let's have a look at old and used vehicle. Different rates have been prescribed for old and used vehicles depending upon size and engine capacity of such motor vehicle and the value of supply. In such cases, when ITC is not availed, is the value that represents margin to the supplier on supply of such goods, which is determined as follows. In case of registered person who has claimed depreciation under section 32 of Income Tax Act on the said goods, then value will be consideration received or depreciated value under section 32. In any other case, selling price minus purchase price. Where you don't claim any depreciation, then you will go by sale price minus purchase price. And if the value is negative, then you will ignore it. When ITC has availed, normal provision will apply. That means you will pay on sale price. Don't forget to apply one thing. See, there is section 18 which says that whenever you are selling a asset, you have to do two comparisons. Tax on transaction value or ITC availed minus 5% per quarter or part of the quarter, and whichever is higher becomes the value. So if the question has all the details of ITC availed, 5% per quarter or part of the quarter, that is, you have the date of purchase and date of sale, then don't forget to apply this whichever is higher, which comes from section 18.6. Careful about this one particular point. In any other case, you will anyways go by this provision only, because this is the main provision which you use for any other asset as well when you are selling it. Clear? Okay, then there is one circular for providing proof that the credit note which I have issued recipient has reversed ITC, because if you recall, post supply known at the time of supply, any discount which is a post supply discount which is known at the time of supply, recipient has to reverse ITC. There was no mechanism to check whether recipient has actually reversed ITC. So CBIC had provided a circular as to how that has to be checked, but this is not there in your ICI module, and hence there is no need for you to go through this. Okay, now let's move on to exemption and reverse charge mechanism changes. See, first of all, you recall Indian Railways. Indian Railways was some time back put under forward charge because they wanted to avail ITC. So all the services by Indian Railways was brought under forward charge. Earlier, only transportation of passengers was covered under forward charge. Now any service by Indian Railways is covered by forward charge. But that was causing some difficulty because some very basic services which are provided to individuals, like platform ticket, facility of renting of a particular room or waiting room, or storing of luggage, or in some new railway stations there is that battery operated car where old passengers or anyone can sit in that car and they'll be taken outside the railway station. So all these provided to individuals, whether GST would be applicable. Government has given some exemptions relating to Indian Railways. Let's see the first one. Service provided by Ministry of Railways to individuals. Careful. By way of platform ticket sale, facility of renting rooms or waiting rooms, cloakroom services to store luggage, battery operated car services, exempted. Then one zone of railways providing services to another zone of railways, that has also now been exempted. So services provided by one zone or division under Ministry of Railways to another zone or division is exempted from GST, because as you recall, different GST numbers, it is regarded as a distinct person, so you will have to issue invoices between distinct person, and hence government has given an exemption so that Indian Railways is not required to issue invoices between its own zones or divisions. Then the third one is also relating to Indian Railways. See, Indian Railways gives contracts to various SPVs. So basically Indian Railways gets special purpose vehicles. Special purpose vehicle meaning separate companies which are involved only in one task. Like some companies are involved in railway tracks, laying of railway tracks. But who uses those railway tracks? It is used by Indian Railways, correct? So Indian Railways maintains it, and obviously SPV charges Indian Railways. Indian Railways maintains that particular railway track. So the question was, those special purpose vehicles, those special purpose companies which are formed for specific purposes providing services to Indian Railways, or Indian Railways providing maintenance to them, whether GST would be applicable. Exemption has been given. Have a look at the entry. Service provided by SPVs to Ministry of Railways by way of allowing Ministry of Railways to use the infrastructure built and owned by them during the concession period against consideration, and the service of maintenance supplied by Indian Railways to SPV in relation to the said infrastructure built and owned by SPV during the concessional period against consideration, because for some time it will remain with them, then it will be transferred to Indian Railways. Okay. Now, the next entry, see, amendment is this explanation to, this is an amendment, and the next full entry is an amendment. These are the two amendments. The first part I have just kept to give you a understanding of what you have already read on this. You have already come across that renting of residential dwelling for use as residence is exempted. Then you remember, except when given to a registered person. So renting of a residential dwelling for use as residence, if it is given to a unregistered person, then in that case it is exempt. Correct? Doesn't matter who is the supplier, because the entry does not talk about the status of the supplier. If it is provided to a registered person, then it is taxable under RCM. But if registered person is a sole proprietor using it in his personal capacity for his personal use, then in that case it is exempt. Only sole proprietor, no one else gets the exemption. Now, the question was whether this entry includes accommodation in relation to paying guest, PG. Whether PG is covered under this. Two changes made. First, an explanation has been inserted saying that PGs are not covered by this entry. But considering that PGs are very important for students or professionals to stay and work in some other states, that's why a separate exemption has been given for PGs. Two conditions. Rent should be up to 20,000 per month per person. 20,000 per month per person, and minimum period of stay should be 90 days. Now, if these two conditions are satisfied, then PGs will enjoy a exemption. Have they given a good limit? To my understanding, it's a good limit which is provided. So PG providing service up to 20,000, charging up to 20,000 plus minimum stay of 90 days will enjoy a exemption. Future there will be a case saying that if it is more than 20,000, whether the full amount will be taxable. To my understanding, yes. For your exams at least, the moment it crosses 20,000, entire amount will be liable to GST, or minimum 90 days. If you don't satisfy that condition, then in that case again it will be liable to GST. So what's the exemption entry? First, PG removed from the main entry, which was a blanket entry. Here the amount of rent did not matter. Now PG has an exemption where the amount of rent matters, plus there is an additional condition. Let's have a look. Renting of residential dwelling for use as residence, except where residential dwelling is rented to a registered person. Explanation 1. This exemption shall cover a registered person who is a proprietor of a proprietorship concern and rents the residential dwelling in his personal capacity for use as his own residence, and such renting is on his own account and not that of the proprietorship concern. Nothing contained in this entry shall apply to accommodation service for students' residence, accommodation service by hostel, camps, paying guest accommodations and the like. This entry will not apply. So blanket exemption is not there. Now let's see. Supply of accommodation service having value of supply less than or equal to 20,000 per month per person, provided that the accommodation service is supplied for a minimum period of 90 days. So per person rent, if it is up to 20,000, then in that case exemption plus accommodation is applied for a minimum period of 90 days, then the exemption will be available. Okay. Next entry, next change is service in relation to transmission and distribution of electricity was already exempted. Transmission and distribution of electricity was already exempted. Any other ancillary services like meter change charges, meter renting charges, duplicate bill charges, meter shifting charges, all these were clarified by a circular that all these will be taxable. Now a special entry is being introduced in the exemption notification 12/2017 to provide that all the ancillary services provided by transmission and distribution utilities will enjoy a exemption. Let's see. Supply of service by way of providing metering equipment on rent, testing of meters, transformers, capacitors, application fee for providing electricity connection, releasing electricity connection, shifting of meter or service lines, issuing duplicate bills, which are incidental or ancillary. Very important, very wide entry. Etc. is generally not used in a exemption entry because that gives scope for interpretation, but this has etc., which are incidental or ancillary to the supply of transmission and distribution of electricity by transmission and distributing utilities to their consumers have been exempted. Okay, then there are various grants which are given by government gives various grants, plus some private companies also give grant. Whom do they give grant to, sir? They give grant to government entities or research associations or universities or colleges or other institutions which already get a benefit under section 35 of Income Tax Act, because there if you give this grant you get a deduction from income tax. So companies giving all these grants to colleges, say suppose Reliance Industries gives a grant for some research and development service to some college, whether exemption will be available? The answer is yes. This is to promote research and development in that college, because the college gets the grant and it agrees, and there is an agreement saying that whatever is the output of this that has to be given to Reliance Industries. They should have the first right to reject. I mean, you understand the term first right to reject. That means you will sell that product, whatever you have developed using that grant, you can sell that technology, you can sell that product at a market price, but first right will be given to the person who gave you the grant. If he does not buy it, then you can sell it to some other person. That's how the contract works on grants. Now the question was whether the grant should be liable to GST. Government has said grants received by colleges, universities, research associations, government entities will enjoy a exemption. So colleges don't have to pay GST, don't have to collect GST on such grants which are received by them. Okay, but yes, they should be notified under Income Tax Act, and at the time of supply of such service they should be recognized under section 35(1) of Income Tax Act, because 35(1) Income Tax Act will already do the checking of such colleges, universities. Then GST department is not required to check. They will only rely on the checking which is done by income tax department. Okay, interesting exemption being given. Let me give you some background. See, central CBSE, ICSE or state boards, Karnataka board, Maharashtra board, the central and state board provide two services. One is examination services and they charge exam fee from the students. This is exempted because central and state board are regarded as education institutes for the limited purpose of conduct of examination. This is already there, which you already know. What about affiliation charges? Affiliation charges is using name of CBSE in your school name or using Karnataka State Board by colleges. Whether affiliation service is taxable. CBIC has clarified that affiliation services are taxable. But what if this affiliation service is provided to government schools? Then whether GST will apply? Now an entry has been introduced saying that affiliation services provided to government schools will enjoy a exemption. There is no GST applicable on affiliation services when provided to government school. When provided to private schools, it will be taxable as it was earlier. Let's have a look. You can write this. Services of affiliation provided by central or state education board or council or any other similar body by whatever name called, very wide, to a school which is established, owned, controlled by central government, state government, union territory, local authority, governmental authority or government entity. So if it is being operated by government, it will enjoy a exemption. What is exempt? Affiliation services. Okay. Then you used to read one entry, National Skill Development Corporation. They have made it much wider because now National Skill Development Corporation has been given a push where this entry not just covers National Skill Development Corporation, it also covers NCVET. I am sure you have heard of NCVT, National Council for Vocational Training. Now this was a very good entry because it's a open-ended entry. It says any service provided. So as it says any service provided, plus it provides any national skill qualification. So it's much wider than the education approved vocation institute entries. So here the services provided by NCVET, they have changed the name. Earlier it was known as NCVT, National Council for Vocational Training. Now it has become National Council for Vocational Education and Training. So any service provided by NCVET will also enjoy a complete exemption, plus any awarding body which is recognized by NCVET. What are awarding bodies, sir? All the sector skill councils of NSW, NSDC are recognized as awarding bodies. Awarding bodies, those who give those certifications. Assessment agencies for this. Training body which is accredited with awarding body recognized by NCVET. They also providing the service is exempted. So they have made it wider, plus they have increased the scope here. It could be National Skill Development Program, any other scheme implemented by NSDC, vocational skill development courses, or any national skill qualification framework aligned with qualification or skill approved by NCVET as part of a qualification package. So they have made it very, very wide. Now as the entry is made very, very wide, any training body which has a partnership with all these will also enjoy a exemption. Can private companies also get covered here, sir? The answer is yes. If private company is a training body which is accredited with National Council for Vocational and Education Training or its awarding bodies, then in that case a plain blanket exemption without any amount or monetary limit will be provided. Okay. Then in the education entry, NCVT is replaced by National Council for Vocational Education and Training. Okay, one interesting exemption is also relating to reinsurance. Do you recall that there were various exempt services, like there was an exempt service relating to Pradhan Mantri Jan Dhan Yojana, hut insurance, cattle insurance, Janashri Bima Yojana, Aam Aadmi Bima Yojana, Jan Arogya Bima policy. Now all these insurance which are exempt. What about reinsurance of them? Reinsurance is where the main insurer cedes some risk to the other insurer. See, I am the main insurer, but I don't want to take so much risk. So I will go to some other insurer and say, you take some amount of the premium, but you also bear some amount of the risk. Then in that case, it is called as reinsurance. Whether that reinsurance will also enjoy an exemption? Now, government has said, yes, reinsurance will also enjoy a exemption. Let's have a look. Reinsurance of exempt service schemes will also be exempt. Retrocession means reinsurance transaction. Retrocession is nothing but reinsurance, whereby part of the assumed reinsurance risk is further ceded to another Indian insurer or cross-border reinsurer. It is clarified that the term reinsurance includes retrocession. So further reinsurance also getting reinsured, that will also be covered under the exemption. So they have made it very wide, because if the main service is exempt, it should not be that one company who is providing the service that will be exempt, all others who are doing reinsurance, that will be taxable. Because if that happens, then it will ultimately become the cost to the end users, and the benefit or the aim of doing that will not get satisfied. Okay. Now, the next entry is again something very critical: import of services relating to foreign airline. Now, let's talk about Emirates. Now, Emirates is a Dubai-based airline. Now, so what happens when Emirates is coming to India? It will have an establishment in India. And does Emirates pay GST in India, sir? Yeah. But it is only registered in India as a branch of a foreign company. They don't have a full-fledged company structure in India. They are registered as a branch of a foreign company. Foreign company, the main company is in UAE. So this Emirates, which is a UAE airline, that will be having a branch in India, and they will be discharging GST on the transportation of passenger service. Because transportation of passenger, what is the place of supply? Where the passenger embarks for a continuous journey. So whatever flights are starting from India and going anywhere else, GST is discharged by the branch of the foreign company. So that's how the transaction works. Now, the question was, the software etc. which is used of Emirates UAE, which is used in India. Now, this UAE company is actually providing service to the branch in India, and it should be a case of import of service. And import of service, the branch of the foreign company should pay tax under RCM, because it is receiving services from outside India to India. So this meant that Emirates has to pay RCM in India. Who has to pay? The branch of this foreign company. Now they seeked an exemption, saying that no, this will be too much. Government gave an exemption, but with various conditions. Condition number 1, they should be only a branch of a foreign company. Condition number 2, Indian airlines like Indigo or Air India should also get the such benefit in UAE. So whatever benefit is being given by India to Emirates should be given by UAE to Indian airlines. Plus, Emirates should pay taxes on transportation of passenger service which is being provided from India. That needs to be done. Now, if these conditions are satisfied, then import of service by a branch of a foreign company of a foreign airline will enjoy a exemption. Let's have a look at the entry. Import of service by an establishment of a foreign company in India, which is an airline company, from a related person or from any of its other establishment located outside India, when made without consideration, have been exempted. Careful, only without consideration ones have been exempted. That means if it is with consideration, then RCM is still applicable. Subject to the following conditions. GST at applicable rates is paid by the establishment of foreign airline company in India on transportation of goods or passengers. One, they are clearly paying the tax on transportation service. Ministry of Civil Aviation certifies that the establishment of foreign company in India is that of an airline company designated by foreign government under the bilateral air service agreement. UAE and India have an agreement, obviously that is going to be covered. Ministry of Civil Aviation certifies that on reciprocal basis, designated Indian airlines are not subject to the levy of similar taxes by whatever name called for the same service under the entry by the government of the country designating the foreign airline company. So UAE should also give an exemption. US should also give an exemption. France should also give an exemption to Indian airlines on reciprocal basis. That will be certified by Ministry of Civil Aviation. Sir, what if the France government is not giving? Then why should we give? Then the tax will be payable under reverse charge mechanism. Wonderful entry. And foreign company will have the same meaning as defined in Companies Act 2013. That's obvious. Okay, let's have a look at the clarifications which are given for certain services. First one is for RERA. You understand RERA? Real Estate Regulatory Authority. Now, whether the services provided by RERA are exempt, statutory collections or statutory fees which is taken by RERA. RERA is a government authority, and recently government had introduced an exemption for government authority, that any authority or board which is receiving pure service in relation to water supply, slum improvement, sanitation, public health, all these will enjoy a exemption. So is RERA a government authority? The answer is yes. Statutory fee collected by RERA, is it exempt or taxable? CBIC has clarified that it is exempt. So any fees collected by Real Estate Regulatory Authority, that is RERA, will enjoy a exemption. This is welcome circular. Then GST on incentives in digital payment ecosystem. You know that government gives incentive for UPI transactions. Government gives incentive for RuPay transactions. So when government is giving incentive for RuPay transactions or government is giving incentive for these UPI transactions, the incentive gets shared further. Say suppose incentive is received by you. You also pass on to your other players who are helping you execute that transaction. So incentive, when it is received by you, it is subsidy, not liable to GST, because government subsidy, already one circular was there. What about further sharing of that incentive? Now CBIC has clarified that further sharing of such incentive will also be not liable, because subsidy is not a consideration at all. Let's see. Incentives from Ministry of Electronics and Information Technology to banks and further sharing by banks to stakeholders are treated as subsidies. These incentives are not taxable, consistent with earlier circular number 190. So further sharing is the new point. Clear? Okay, then one more circular where some more points were issued. These are very simple, like affiliation services to college. Tell me, university providing affiliation service to college, taxable because it is not exempted. Affiliation services by central and state boards to schools, taxable, but if it is to a government school, then it will be exempt. You are aware of this? Then DGCA approved flying training courses by flying training operators. What about flying training operators providing approved courses? Same way, Vessel Merchant Shipping Act, already government had given an exemption. Now government has said that flying training courses will also enjoy a exemption provided by flying training operators. Then this is relating to supply chapter, but as it is part of a circular and very small point, I've kept it here. What is it? GTA. Now goods transport agencies provide transportation of goods and also provide loading unloading. Now the question is whether loading unloading is a separate supply or incidental or ancillary. And the winning answer, I am sure you would have got it. The winning answer is incidental or ancillary. So what's the principal supply? Transportation is the principal supply, and together it will be incidental loading. So composite supply principal applied, what will be the rate? Transportation of goods. Sir, but what if only loading and unloading charges is provided? That is simple. If I am only providing loading and unloading charges, then it will be separately taxed as loading and unloading charges. So mark it as important. I expect a question on this. Okay, then preferential location charges has been a matter of dispute. See, when you buy a property, say suppose there are 4-5 plots here, then which will be the most expensive one? Corner property or middle property? Sir, corner property will be most expensive one. So here they charge extra preferential location charges. Name has the meaning, preferential location charges. So the question is whether preferential location charges will be exempt or taxable. Now preferential location charges taxability will depend on this. Say suppose this is long-term lease of industrial plots for 30 years or more, then PLC will also be exempt. This is already there in one circular. Now say suppose it is related to residential property, then residential property, if the rate of tax is 5%, then PLC will also have 5%. That means PLC is incidental or ancillary to the main service of providing residential basically construction of residential property. Commercial property 12% is there, same rate will apply for preferential location charges. So the rate will anyways be given in the question to you. You have to apply same rate which is applicable for the construction industry for preferential location charges. So they have clarified that PLC is part of the composite supply and same treatment is applicable. Okay. Now let's talk about the changes in RCM. Two important changes have happened. First is there were cases of tax evasion relating to metal scrap. So in the newspaper there were a lot of reports that there have been multiple cases of tax evasion related to metal scrap. Now because of this, government brought two changes saying that, say suppose unregistered person is supplying metal scrap to a registered person, then the registered person will have to pay the tax under RCM. This is the first change, and as you know, goods related RCM are applicable for your exams. So metal scrap from unregistered person to registered person will pay the tax under RCM. Then the second one is, say suppose the transaction is between two metal scrap persons where both are registered, then they have covered this particular transaction under TDS under section 51. Earlier TDS, tax deducted at source, under GST was applicable only for government being the recipient. Now one more additional point has been added there, between two registered persons dealing in metal scrap. We will learn this again when we discuss TDS related changes. What about supplier being registered and recipient being unregistered metal scrap? Now here it will be a clear case of taxable forward charge. There will be no RCM and there will be no TDS under section 51, because TDS will apply only when both are registered person. If supplier is unregistered, then taxable under RCM. Again, in this case also there is no TDS under section 51. So just be careful of these three cases. Better write and keep. Second, talking about residential property and commercial property. See, residential property, you already know the law. Residential property, if you give it for commercial use, residential property for commercial use. Now if you give it to a unregistered person, then it is taxable under forward charge. If you give it to a registered person, then it is taxable under RCM, irrespective of the status of the supplier. Doesn't matter who is the supplier. We are talking about the recipient in all these cases. Supplier could be registered, unregistered will not matter. If residential property is given for residential use, then in that case, if you give it to a unregistered person, then it is exempt. We just saw it some time back. If it is to a registered person, taxable under RCM. But if it is a sole proprietor for his personal use, in his personal capacity, then again it enjoys a exemption. This we are already aware of. Now let's talk about commercial property. Now commercial property was always taxable under forward charge. That means only when supplier is liable to register, then only GST will apply on commercial property. Now what government has done? Commercial property, unregistered person to registered person. Supplier is unregistered, recipient is registered. This is now covered under RCM. Sir, what if both are registered? If both are registered, then it will be taxable forward charge. If supplier is unregistered, recipient is also unregistered, then no GST will be applicable. Sir, what if supplier is registered, recipient is unregistered? Then taxable under forward charge. I think they can ask you first two. They will say an unregistered person has given on rent. Given on rent meaning taxable RCM. Two treatments from the angle of recipient will be you will get ITC. Second, you will have to pay tax under RCM. And second, both registered person, you don't have to worry about payment of tax because supplier will pay tax, you will get ITC. And in this also they could give you a common credit where you will have to do E by F, exempt turnover divided by total turnover. So just be very careful on these two cases. Institute may ask a good 5-mark question on this separately or include it in case study based MCQ or also include it in the regular first question which contains all the provisions. So just be very careful on this commercial property, residential property. Institute can mix up everything. Okay, now coming to the changes with respect to input tax credit. The first change which has happened is in conditions to avail ITC in case of cancellation and subsequent revocation. Now see how it will work. Say suppose a person's registration is cancelled. Then he will apply for revocation. And after he applies for revocation, there will be an order of revocation. Correct? Now, all this will take time. Cancellation order, then applying, then order. Now, say suppose this period, 30th November lapses. What is 30th November, sir? If you recall, for a financial year, say suppose we are talking about FY 23-24. FY 23-24, the last date to avail ITC is 30th November after the financial year or date of filing annual return, whichever is earlier. Now say suppose this date falls during cancellation and you were not able to avail ITC, but you have got back your registration. Now when you get back your registration, the question is this FY 23-24 ITC which you have not claimed, can you claim it after the order? Because after this 30th November has already lapsed. Now government has come up with an amendment saying that from the order within 30 days you can avail ITC which lapses during this period. If any ITC lapses during this period, that is from the date of cancellation order till the date of order of revocation, then ITC can be availed within 30 days from the order of revocation. That means technically now in case of cancellation, the last date to avail ITC will be 30th November after the financial year or date of filing annual return, whichever is earlier, or 30 days from order of revocation and whichever is later. Because if at the end of this period, if 30th November has not lapsed, then you can claim, then there is no difficulty. Say suppose the cancellation happens somewhere in April and you get back the registration in September, then 30th November only will be available as last date to avail ITC. This provision is only to help in those cases where ITC has lapsed during this period. Now as ITC lapsed during this period, you are facing a difficulty, and to cover that, government has said you can claim ITC within 30 days from the order of revocation. Keep this diagram with you. I think they can ask you a case study based question on this. So mark it for case study. Let's have a look at the law. If a person's GST registration is cancelled under section 29 and then later restored, that is revoked, through section 30, an appellate authority, tribunal or court order then they can claim input tax credit for invoices or debit note from the time before cancellation, provided ITC wasn't restricted at that point of time. Person can claim ITC in the return under section 39 by 30th November following the financial year or before filing of annual return, whichever is earlier. This is first one. Second one, if cancellation period is covered, then ITC can be also claimed for the period between the cancellation date and revocation order date, as long as the return is filed within 30 days from revocation order. In short, ITC can be claimed up to later of the two deadlines, either 30th November 1 or 30 days from order of revocation, whichever is later. Very important for exam case study question. So the second point relates to ITC not available in case of tax paid based on any order where the demand is confirmed on account of fraud, willful misstatement, suppression of facts under section 74. What is added is under section 74. Earlier, this line was already there, that in case any amount is paid which is in pursuance to any demand order by fraud, willful misstatement or suppression of facts, ITC was not available. Now they have added under section 74. That's the only change. Then coming to the third one. Third one is a circular issued by CBIC on time limit for availing ITC in case of RCM cases. Say suppose for FY 22-23 there was an invoice, purchase forward charge. Then in that case, what is the last date to avail ITC? The last date to avail ITC is 30th November 2023. We are already aware that this will be the last date to avail ITC for invoice pertaining to FY 22-23. Now let's talk about, say suppose I received a service under RCM. Now I received this service in FY 22-23, but I did not pay tax under RCM because supplier was unregistered. So I did not know whether I have to pay tax under RCM. And whenever RCM supplier is unregistered, I have to do a self-invoicing as a recipient. So as a recipient, my duty is to do a self-invoicing. So I did not do a self-invoicing because I thought RCM is not applicable on this transaction. Then FY 24-25, the officer says that this RCM is applicable, pay RCM. This is the demand by officer. Now, the moment this demand is raised by officer, I realize that I had to pay tax under RCM. Now, I raise an invoice here. Recipient issues self-invoice in FY 24-25. My question to you is, when the self-invoice is issued, can I take RCM ITC on this self-invoice based on FY 24-25 last date to avail ITC or 30th November 2023? CBIC has clarified that if the invoice is issued in FY 24-25, the last date to avail ITC for this will be 30th November 2025. Is it a welcome circular? The answer is yes. But obviously there are implications. Interest will apply from here to here because time of supply of that transaction would have already arisen in FY 22-23. What's the time of supply for services? 61st day from the date of invoice or date of payment, whichever is earlier. So that would have happened here. So from the time of supply and based on time of supply, we will arrive at due date to pay tax. From the due date to pay tax till the date of payment of tax, I will have to pay interest. And can penalty apply? The answer is yes. Penalty can apply because I have delayed raising invoice. As I have delayed raising invoice, there is a penalty under section 122, 25,000 CGST, 25,000 SGST. So those implications would have been there even if ITC was not available. So at least I am now getting the ITC for RCM invoices. So what's the conclusion? RCM invoices, I can avail ITC by the 30th November after the financial year in which I had issued the self invoice. Clear? Let's go through the circular. And mark it as important. Institute may test you on this. Clarification on time limit for availing ITC under section 16.4. 16.4 is 30th November of CGST Act in respect of RCM supplies. It is clarified that in cases where supplies are received from unregistered suppliers and the tax is required to be paid by the recipient under RCM, the relevant financial year for calculating the time limit for availing ITC under 16.4 will be the financial year in which the invoice is issued by the recipient in accordance with 31(3)(f). Invoice issuance, the recipient issues the invoice after the time of supply and pays tax. Accordingly, they will be required to pay interest on delayed payment of tax. Penal actions, delayed issuance of invoice, they may be liable to penal action under section 122. Okay. Fourth one is quite interesting. Now, let me give you some background. Rule 32. Life insurance sector. Now, life insurance sector has some valuation mechanism. For instance, if it is risk-based policy, then the entire premium is liable to GST. Entire premium is liable to GST. If it is investment-based policy, then if the breakup is informed to the policy holder, then in that case risk portion liable, investment portion not liable. Correct? And if the breakup is not available, about the risk portion and investment portion at the time of issuance of policy, then in that case first year premium 25% will be considered as liable to GST and subsequent year premium 12.5% will be considered as liable to GST. Plus, if it is single premium annuity policy, 10%. Now the question was, when the insurance company is paying tax only on 25%, does that mean 75% is exempt turnover leading to ITC reversal under rule 42 and 43, that is E by F, exempt turnover divided by total turnover? Should ITC reversal be required for 75%? Same way investment portion is not liable, so should ITC reversal be required for that? Same way here 87.5% is not liable, whether ITC reversal is required for that. Now that was the question. CBIC has clarified that this is not a exempt turnover. This is a valuation mechanism. Now in valuation mechanism, you cannot say this is exempt turnover, as exempt turnover is only three things: something which is wholly exempt, something which is subject to nil rate, and the last one is non-taxable supply. Other than that, everything is taxable supply. Hence, CBIC clarified that there is no need to do ITC reversal in such cases. Let's have a look. Circular 214, 26 June. Clarification on reversal of input tax credit for life insurance premium not included in taxable value. So something which is not getting included in taxable value, whether we have to reverse ITC for that. Whether the amount of insurance premium not included in the taxable value as per Rule 32(4) of CGST rules for life insurance businesses should be treated as pertaining to non-taxable or exempt supply for the purpose of reversal of ITC as per 17(1) of CGST Act, read with Rule 42 and 43. It is clarified that the amount of premium for taxable life insurance policies which is not included in taxable value cannot be treated as pertaining to non-taxable or exempt supply. Very good clarification. Therefore, there is no requirement for reversal of ITC as per 42 or 43 or the said amount. Okay. Then you have a circular relating to warranty. This was not included earlier because if you see, this came in July 2023. So earlier exams, institute had never included it in statutory update. But now in the new module, this is included. So that's why we are going to read this circular. Now, warranty replacement. Very good circular. See this carefully. See, we'll talk about Honda. See, Honda is a OEM, original equipment manufacturer. Now, when we say Honda is a original equipment manufacturer, it is manufacturing Activa vehicles. We'll take an example of Activa, two-wheeler being manufactured by Honda. Now, Honda gives a warranty to customer. Say suppose there is an engine failure within some period, then there is warranty which is given to the customer. Now the charges for this warranty is already included in sale price of vehicle. So it is already included in the sale price of vehicle. Now the question is, say suppose the engine undergoes some damage or the vehicle is of default nature, there's some defect in the vehicle. Then what will Honda do? Honda will replace the parts. And they will do it free of cost. So there will be no GST applicable on replacement of parts because it's already covered under warranty. As it is already covered under warranty, it will be replaced free, no GST applicable. The next question was, Honda would have purchased parts, whether, and they would have also taken ITC on this, whether ITC is required to be reversed in this case. CBIC has clarified, no need to reverse ITC. Sir, but we are giving free now. No need to reverse ITC. But it's free. Wait. It's actually not free. The price of the warranty was already included in the price of the vehicle. So you have already charged this from the customer, and hence CBIC has clarified that here there will be no GST. Here there is no need to reverse ITC because the cost of this is already recovered from the customers. Sir, what if some additional consideration is charged? Say suppose some nominal amount only, but additional consideration charged. Whether GST will apply on such additional consideration? The answer is yes. This additional consideration will be liable to GST. That's obvious, because if you charge something extra, then that extra will obviously be liable. But if you give it free, then in that case, there is no GST implication. Very good point given by CBIC. Now, let's have a look at the wordings. Case 1. Okay, clarification on availability of ITC in respect of warranty replacement of parts, repairing service during warranty period. We'll talk about repairing in some time. OEM, original equipment manufacturer, offers warranty for the goods supplied by him to the customer and provides replacement of parts or repair service to the customer during the warranty. The value of original supply of goods provided along with warranty. Original supply of goods is the two-wheeler which was sold initially by the manufacturer to the customer includes the likely cost of replacement of parts and or repair service to be incurred during the warranty period, on which tax would have already been discharged at the time of original supply of goods. Therefore, in cases where no separate consideration is charged by the manufacturer at the time of such replacement or repair, no GST is levied on such replacement of parts or repair service during warranty period. However, GST is levied in case of additional consideration is charged for the same. These supplies cannot be considered as exempt supplies, as original supply is likely to include the cost of replacement/repair service to be incurred during warranty. Hence, the manufacturer who provides replacement parts or repair service to the customer during warranty period is not required to reverse input tax credit in respect of the said replacement parts, not required to reverse ITC or repair service provided. Clear with this? This is the first one. Case 2 is if we add a distributor. Let's add. See, here is the distributor. Distributor is the dealer who is actually selling the bike to the customer. Now, distributor of Honda is the front face to the customer. Now, what if the distributor is giving free part to customer? Whether GST will apply on this free part? CBIC has clarified that GST would not be applicable on this free part which distributor is giving to customer. Now think from the other angle. Whether distributor will get the payment of this from the manufacturer? The answer is yes. Let's see that. Now, case 1. Distributor invoices manufacturer, that is Honda. Now, in this case, whether distributor should charge GST to Honda, say suppose amount charged for the replaced part which was given free of cost to the customer, whether GST will apply? The answer is yes, GST applicable. Now, whether Honda will get ITC of that? Honda will get ITC. So, what is the net impact? 0, because distributor will end up paying output on this and Honda will end up getting ITC on this. The net impact of the transaction will be 0. But sir, why is the net impact 0? The answer is very clear, because when distributor would have sold it to customer, the warranty which is provided by Honda, the cost of that warranty was already included in the value of vehicle on which GST is already discharged, and hence free part there will be no GST. Then distributor supplying this free part to customer and getting part replacement from Honda. Now what about this situation? Where second situation is he is not invoicing, he is getting the replacement part from Honda. When Honda is giving this replacement part, let me just make it like this. This is second case. First case is he has invoiced and the transaction gets closed. Second case is Honda, instead of paying for that, he says please take this part which you have given to the customer. Now in this case, whether GST will apply in this? No GST. Whether Honda has to reverse ITC? No ITC reversal. No ITC reversal, sir. Obviously no ITC reversal. Why no ITC reversal, sir? It's very simple. See, at the end of the day, is GST already discharged on the warranty charges which was charged to the customer? The answer is yes. So there should not be any impact on this free part. And that's why the replacement given by Honda to distributor, there is no GST, plus Honda will not have to reverse ITC taken on that part which is being given as a replacement to distributor. Okay. The third possibility can be Honda issues, let me keep it here, Honda issues credit note of that amount to distributor. Credit note of the amount of free part. Now in this case, this credit note can be with GST or without GST. If it is with GST, Honda will reduce its output, distributor will reduce its ITC. Net impact again 0. If it is credit note without GST, Honda will not reduce output, distributor will not reduce ITC. No impact of the transaction. If you see in all the three cases, the net impact of the transaction is 0, because when distributor invoices, they will charge GST, Honda will get ITC. When free is given as a replacement, no GST anywhere, no ITC reversal. When credit note is issued, one person will reduce output, one person will reduce ITC. Net impact of the transaction is 0. So the end result is, as when we initially charge to the customer, we have already charged GST. There is no need to additionally charge any GST. Now same principle is also applicable when free service is being provided. Now say suppose free service is being provided by distributor to customer. On this free service, whether GST will apply? The answer is no. But distributor charges Honda. When distributor charges Honda, for us it is free. When distributor charges Honda, whether GST will apply? Yes. Whether Honda will get ITC? Yes, Honda will get ITC. Sir, what if with free service we charge something? If we charge something to the customer, then in that case obviously GST is applicable. That is true in any case. Clear? Okay, let's go through case 2, case 3. Case 2 relates to this 3 cases. Case 3 relates to free service. And then there is one case for warranty which we will discuss, extended warranty, which we will discuss after these two. Case 2. The distributor provides replacement of parts or repair service to the customer as part of warranty on behalf of the manufacturer without charging any consideration from the customer. Where no consideration is charged by the distributor from customer. Distributor is not charging anything. No GST is payable by the distributor on the said replacement during the warranty period. In case additional consideration is charged, GST will be applicable. Now coming to treatment relating to ITC and output liability relating to replaced products will be as follows. Let's see A. In case where distributor replaces the part to the customer under warranty, either by using his stock or by purchasing it from third party, and charges the consideration of the same from the manufacturer. This is where distributor invoices manufacturer. By issuance of tax invoice, then GST would be levied on the consideration charged by distributor from the manufacturer. The manufacturer is eligible to take ITC of the same subject to other provisions. Further, no reversal of ITC by distributor is required in respect of the same. Obviously, I have already charged. Okay. B. In case where the distributor raises a requisition to the manufacturer for the part to be replaced by him under warranty, and the manufacturer provides the said part. This is where manufacturer provides part. To the distributor for the purpose of such replacement to customer as part of warranty, then no GST would be payable if no additional consideration is charged by the manufacturer in respect of the parts replaced. Further, no reversal of ITC is required by the manufacturer. Third one is, in case where the distributor replaces the part to customer under warranty out of the supply already received by him from the manufacturer, and manufacturer issues a credit note under section 34 in respect of the parts replaced, the tax liability may be adjusted by manufacturer subject to distributor has reversed ITC availed against the part so replaced. This third case is where credit note is being issued by the manufacturer. Clear? Okay. Next one, case 3 is very simple. The distributor provides repair service in addition to replacement of parts or otherwise to the customer without any consideration as part of warranty on behalf of the manufacturer, but charges the manufacturer for such repair service. As per 293, in this case there is a supply of service by distributor and the manufacturer is the recipient, because who is liable to pay consideration? Manufacturer. The person who is liable to pay consideration, he is the recipient of such supply of repair service. Hence, GST shall be payable by the distributor on such supply of service to the manufacturer, and the manufacturer would be entitled to claim ITC in respect of the said supply. Okay. Case 4. Case 4 is related to extended warranty. This is the last discussion. Now, extended warranty, see what happens when you purchase a new vehicle. They will also offer you extended warranty. Say suppose you take extended warranty that time. So when you are taking vehicle, at that time you take extended warranty. If you take the extended warranty at that time, then both will be considered as composite supply and principal supply rate will be applicable. What is the principal supply? Vehicle is the principal supply. Principal supply rate will be applicable. Clear? But if vehicle is sold later, extended warranty taken, then this extended warranty is a separate supply. Now one issue arises. What if vehicle is being sold by distributor and extended warranty is sold by third party. There is some third party who is providing extended warranty. Then can it be regarded as a composite supply? That's the question. CBIC clarified further. This was the new circular. The new circular, again based on extended warranty, said it will be regarded as composite supply only when sold by the supplier. When extended warranty is being sold by the supplier. So if some third party is selling this, then it is a separate supply. Only when the distributor was selling this extended warranty, then it would be a composite supply. If some other third party, be it even Honda, the manufacturer, if the manufacturer is selling this extended warranty, then in that case, this is different, this is different. This is sold by distributor, this is sold by some other person. How can you make composite supply when two different suppliers are there? So a very important conclusion which is coming out of this particular circular is extended warranty or any other type of incidental charges will be regarded as incidental charges only if the incidental charges is being provided by the supplier of the principal supply. If I am supplying the principal supply, then incidental charges will be considered as incidental or ancillary to the main supply. If incidental thing is done by someone else, then you can't make it as a composite bundle. Clear? Okay. Let's have a look. First they gave a simple circular, then they revised it saying wherever parts is mentioned, here they had mentioned parts, wherever parts are mentioned, it will also include goods. I mean, parts is something which is required for the vehicle. What if replacement of any other goods which is accessory is done? Same treatment will apply. That was clarified by another circular. Okay, first let's complete this, then we'll see the next one. Extended warranty services provided by manufacturer or distributor to the customer, which can be availed at the time of original supply or before the expiry of standard warranty period. If the customer enters into an agreement for extended warranty at the time of original supply, then it would be considered as a composite supply, principal supply being supply of goods. GST would be payable on the consideration for such extended warranty along with principal supply at the rate applicable on the principal supply. If the customer enters into an agreement for extended warranty at any time after the original supply, then it would be considered as a separate contract. GST would be payable by the service provider, whether manufacturer or distributor or third party, depending on the nature of the contract. Then further clarification issued on 26/6, GST liability and ITC reversal for replacement of goods or parts under warranty. They have clarified that whatever is said above will apply to any reference to part will include reference to goods also. Then second, distributor replaces the part, any replacement, any reference to parts will also include goods. This one is additional. This is where they have clarified that extended warranty at that point of time only when it is provided by the supplier of the goods at the time of original supply. See this carefully. Determining the nature of supply when extended warranty is provided at the time of original supply of goods. If the extended warranty is provided by the supplier, this is the additional point. See, earlier also they had said this, but this word supplier was missing. If the extended warranty is provided by the supplier of goods at the time of original supply, it is part of composite supply with goods being principal supply, and GST is payable accordingly. If the extended warranty is supplied by a different person, then it is treated as a separate supply and is taxable as such. Then, nature of supply of extended warranty made after original supply of goods. If it is made after original supply of goods, it is a distinct supply of service. It doesn't matter who is the supplier. Even if the person who has supplied the original supply, if he is providing extended warranty, then also it is regarded as a separate contract. Clear? Okay. Let's have a look at circular number 217, which talks about whether insurance company will get ITC of repair invoices. Interesting case. See, say suppose there is a vehicle accident. Now if there is a vehicle accident, it is taken to the repair center, and then repair center will issue invoice. Now two invoices can be issued. Invoice 1 can be to insurance company, where insurance company would have agreed that this much I will pay, or invoice 2 can be to the customer. Now whether customer will get ITC of this repair depends on whether he is eligible to take ITC on the vehicle. If he is eligible to take ITC on the vehicle, like truck is eligible for ITC, so repair of truck payment made by customer will also be eligible if the invoice is in the name of customer plus other conditions. GSTR1 is filed, it is reflected in 2B, all that should be satisfied. Now whether insurance company will get ITC of this, CBIC has clarified yes, to the extent insurance company has approved the claim. Say suppose insurance company approves that the repair charges is 1 lakh, and out of that 92,000 is approved by insurance company, 8,000 customer has to pay. Then on this 92,000 which is approved by insurance company will be eligible for ITC provided the invoice is in the name of insurance company. Sir, what if the invoice is in the name of customer? Then insurance company will not get ITC, because one of the conditions is the invoice should be in your name. You should be in possession of the invoice. You should have received the goods or services. Supplier should have filed GSTR1. It should be reflected in 2B. Now if the invoice is in customer's name, how will it come in your 2B? And if it is not coming in your 2B, you will not get ITC. So insurance company will get ITC only when the repair center invoices to the insurance company. It is the approved cost, not full. If it is full, then proportionate ITC, and other conditions needs to be satisfied, which are general conditions for availing ITC. Clear? Let's have a look. In fact, we discussed this in the class as well, even before the circular had come. Anyways, let's read it. You remember, manufacturer of motor vehicle, for vehicles manufactured by them, they are eligible. Insurance company for vehicles insured by them. Basically, that's what has been clarified. Entitlement of ITC by insurance company on expenses incurred for motor vehicle repairs in reimbursement mode of insurance claim settlement. Whether ITC is available to insurance company on expenses incurred for repair of motor vehicle in case of reimbursement mode of insurance claim settlement. When the insurance company reimburses the insured for repair cost under the reimbursement mode, insurance company is liable for approved repair cost and is considered the recipient of repair service. As such, ITC is available for repair expenses incurred provided it pertains to approved claim cost and is not restricted under 17(5). ITC extent when invoice exceeds approved claim cost. If the garage issues two separate invoices, one to insurance company for approved claim cost and another to customer for excess amount, ITC may be available to insurance company on the invoice issued to it subject to reimbursement. If a single invoice is issued to the insurance company but the insurer reimburses only approved claim cost to the insured, ITC will be available only to the extent of reimbursed approved claim costs and not on full invoice value. ITC availability when invoice is not in the name of insurance company. This is dead end. If the invoice for repair of vehicle is not in the name of insurance company, the conditions of section 16 are not satisfied, ITC will not be available to insurance company. If it is not in the name of insurance company, then they will not be eligible for ITC. Okay. Then let's talk about one interesting area. Now, if you understand technology very well, you understand optical fiber cable. Optical fiber cable is based on which we use internet, based on which we use geo connections. So optical fiber network is very important. So to lay down optical fiber, they use all the ducts and manholes. Ducts and manholes is gutter. So ducts and manholes. So first the pipeline will be laid and then the optical fiber network will be laid and then ducts and manholes will be put. So the question was whether this ducts and manholes is immovable property or is it plant and machinery, because construction of an immovable property is blocked under section 17(5), no ITC. But if it is relating to plant and machinery, then ITC is available. So that was the question, whether it is blocked credit or is it eligible for ITC. CBIC clarified that it is eligible for ITC because plant and machinery has only 3 exclusions: land, building or other civil structure, pipeline outside the factory, last one, telecommunication towers. Only these 3 things are not eligible, as ducts and manholes are not covered in these 3 things. Ducts and manholes will be eligible as ITC. Let's have a look. Clarification of availability of input tax credit on ducts and manholes used in optical fiber cable network. Whether input tax credit is available on ducts and manholes used in the network of optical fiber cable as per 17(5) of CGST Act. Ducts and manholes are integral components of OFC network, which is essential to provide telecommunication service. Under explanation to 17, ducts and manholes fall in the definition of plant and machinery, as they are used as part of OFC network, optical fiber cable network, for making outward supply of telecommunication signal transmission. Ducts and manholes used in OFC network are not specifically excluded from the definition of plant and machinery. In explanation to section 17, they are neither in the nature of land, building, civil structure, nor telecommunication towers, nor pipeline laid outside the factory. Therefore, availment of ITC is not restricted in respect of ducts and manholes used in OFC network. So, will you get ITC? The answer is yes, you will be eligible for ITC. Okay. Now the next one is demo vehicles. What do you think? All the dealers of motor vehicles use demo vehicles. whether demo vehicles will be eligible for ITC. CBIC has said yes, it is for further supply of such motor vehicle and hence demo vehicles will be eligible for ITC. But say suppose one demo vehicle is only used for marketing service, then in that case it will not be eligible for ITC. And lastly, what happens to these demo vehicles is it is added to your fixed asset, so it is capitalized. Now say suppose you have claimed depreciation under section 32 of Income Tax Act on this GST component, then whether ITC is available? The answer is no. If depreciation under section 32 of Income Tax Act is claimed on these demo vehicles, then ITC will not be available. That's the simple clarification. Let's have a look. Important, mark it as important. Demo vehicles used by authorized dealers for showcasing and demonstrating vehicles to potential buyers are purchased against tax invoice and capitalized as assets in the dealer's books. Dealers may sell these vehicles, they sell it later at reduced value after mandatory period. The key issue include the availability of ITC on demo vehicles with an approved seating capacity of not more than 13 passengers and when these vehicles are capitalized in the dealer's books. Clarifications reveal that 17.5a ITC is generally not available to motor vehicle with seating capacity of up to 13 passengers except for further supply for passenger transport or driving or training. Such demo vehicles are used to promote and facilitate sale of similar vehicles. They qualify for ITC under the exclusion of further supply of such motor vehicle. However, if the vehicle is used for non-supply purposes or if the dealer provides only marketing services, he does not sell any vehicle, he only displays it, orders are directly given to the main manufacturer, then ITC is not available. Regarding capitalized demo vehicles, ITC remains available if conditions of section 16(1) of CGST Act are met. However, ITC cannot be claimed on the tax component if depreciation is claimed and tax must be paid on sale of capitalized vehicle as per 18.6 read with rule 44.6. What does 18.6 deal with? Whenever a fixed asset, whenever you are selling or disposing of capital goods, then in that case, what does the law say? The law says you have to pay tax on transaction value or ITC availed minus 5% per quarter or part of the quarter, whichever is higher. Okay, then Institute has also added one very famous Supreme Court judgment of 2024. So they have added this judgment of Supreme Court. Now let me tell you the issue. See, any goods or service used for construction of immovable property except plant or machinery is blocked when it is for own account. Then next point was any works contract used for construction of immovable property except plant and machinery. Now this plant and machinery had 3 exclusions. 1. Land, building, other civil structure, pipeline outside the factory, and the third one was telecommunication towers. This you have already read. Now see this. In this point, plant or machinery was mentioned. In works contract point, plant and machinery was mentioned. And the definition was given for plant and machinery. Supreme Court held plant or machinery is not same as plant and machinery. That means land and building is excluded, but only for works contract. Land and building is not excluded for goods or services used for construction of immovable property, because here the exclusion is plant or machinery, and plant or machinery is not defined in the law. That means if I am constructing a mall and giving it on rent, it might be a plant for me and I might be eligible for goods or services which are used for construction of this plant. For me, mall will be regarded as a plant. And they redirected the case to High Court, saying that check whether the case is relating to plant and can plant have a separate meaning compared to plant and machinery exclusion, because the exclusion is only for plant and machinery. Exclusion is not for plant or machinery. This was the Supreme Court judgment. Now, Institute has kept this judgment for May 2025 exams. It will apply. Not sure for November 25 exams, because GST Council 55th meeting happened in December, where they have given a recommendation that change this or to and. That means the Supreme Court judgment will be nullified after this. Plus, one more important conclusion in Supreme Court judgment was these two entries are not ultra vires, meaning it is valid. Government can put such restrictions on denial of ITC for goods or service used for construction of immovable property. Plus, they have also held that the time limit to avail ITC is also not ultra vires to the Constitution. There can be a last date to avail ITC. So, this second part of the judgment will still remain good for future as well, that these two clauses are not ultra vires and time limit to avail ITC is also not ultra vires to the Constitution. For May 25, this will be there, plant or. For future exams, we'll have to see when the Finance Act gets notified in future. So let's have a look at the judgment. Distinction between plant and machinery and plant or machinery. The Supreme Court distinguished between plant and machinery in 17(5)(c) and plant or machinery in D. This is relating to works contract. And 17(5)(d) is relating to any goods or service. While plant and machinery is defined in explanation to 17, plant or machinery is not, indicating a deliberate legislative distinction. The court held that the terms are not interchangeable. ITC is allowed for works contract service used for construction of plant and machinery as defined under 17(5)(c) and for plant or machinery under 17(5)(d) under specific conditions. Meaning of plant or machinery and immovable property. The court explained that plant or machinery in 17(5)(d) includes plant classified as immovable property if integral to taxpayers' business. Since plant is not defined in the CGST Act, its ordinary commercial meaning applies, while structures like malls, warehouse and buildings qualify as plant. Depends on their business purpose, such as leasing or renting out under Schedule 2 classification. If so, they are excluded from 17(d), enabling ITC claim. Constitutional validity and business implications. The court upheld the constitutional validity of 17(5)(c). 17.5D is also valid. 16.4 is time limit to avail ITC. Businesses must assess the role of structures in their operations to determine if they qualify to be plant or machinery for eligibility of ITC. This judgment clarifies that ITC claim on construction related expenses, emphasizing alignment with CGST Act provisions. Yes. So for your exams, if a mall is using any goods or service for making that mall and giving on rent, whether ITC will be eligible? Yes, because mall will qualify to be plant and ITC for goods or services to make it is eligible. But mall is not plant and machinery, so ITC for works contract to make it is blocked. Careful on these two things. So if you are giving something for renting out, then it will be eligible. I mean, Supreme Court has said it, but already the law is getting amended. So maybe 1 or 2 attempts this will be there. After that, everyone will forget this. Yes. Okay. Now let's move on to the changes in registration, payment of GST, TDS, TCS. First clause, very important. One new clause has been added in officer's power to suo moto cancel the registration. Now, see, say suppose the registration is cancelled and the taxpayer applies for revocation. After applying for revocation, grant of revocation, this is called as order of revocation. Now after getting this order of revocation, he has to file all the pending returns from the effective date till the order of revocation within 30 days from the order of revocation. File the returns. Now say suppose he does not file the returns within 30 days. Then can officer again initiate suo moto cancellation? The answer is yes. His registration which has been revoked will again be cancelled. Is it, sir? Yes. So this point has been added. Let's have a look. Section 29 read with Rule 21, registration to be cancelled in certain cases. A new clause is inserted to provide that registration can be cancelled if a person does not file pending returns from the effective date of cancellation till the order of cancellation within 30 days from the date of order of revocation of registration. So, if you get the order, then you will have to file the returns within 30 days. Okay, this is the first one. Second point is relating to section 23, which talks about persons not liable to register. Now, persons not liable to register had a point that if your supply is covered completely by RCM, then you are not required to take registration, correct? If your supply is covered under RCM, you are not required to take registration. Exclusively supplying something which is covered under RCM. Now metal scrap has been put under RCM. If you are exclusively supplying metal scrap, does that mean you will be not required to register? The answer is no. So they have provided that this provision will not apply to metal scrap dealers. Let's see. Persons who are only engaged in making supplies of taxable goods or services and the total tax to be paid under reverse charge by the recipient of such goods or service under 9(3) are exempt from obtaining registration. However, it has been amended to specify that this exemption shall not be available to any person engaged in supply of metal scrap falling under Chapter 72 to 81 of First Schedule of Custom Tariff Act. Okay. Third one, quite important. Section 50 read with Rule 88B. One very good change has been made. Say suppose June 2025. Now what's the due date for June 2025? The due date for June 2025 will be 20th July 2025. Now I deposited the money. Say suppose output tax was 1 lakh, ITC was 80,000, and I had to pay how much through e-cash? 20,000 I had to pay through e-cash. Due date was 20th. So I deposited 20,000 in e-cash on 20th. But I did not file the return. I filed the return on 25th July 2025, filed GSTR 3B. Question is whether interest will apply for these 5 days. Now the rule has been amended saying that if you have kept the money in e-cash, then no interest. No interest. No interest. If money is available in e-cash ledger, then interest cannot apply. A very good point, very important for your exams. Such case study can be given in your examination as a case study based MCQ, or it can come as a normal MCQ. It can also come as a 3-mark question on a case study writing. Let's see. Interest will not apply on amount which is lying in e-cash ledger on or before the due date for filing the return, from the due date till the date of debit at the time of filing the return. Okay, biometric Aadhaar authentication has been extended to all states. Earlier it was applicable only for Gujarat, Andhra Pradesh, Puducherry. Now it is extended throughout India. TCS rate reduction. Earlier TCS was 1%, now that is reduced to 0.5%. That means CGST 0.25% and SGST 0.25%. Don't mix up. TDS rate is 2%, which is constant. TCS has been reduced from 1 to 0.5. Coming to the next change, TDS on metal scrap. Metal scrap, TDS has been introduced under section 51. See, earlier TDS was applicable only when recipient is government department, local authority, PSU, government agency, authority or society set up by government. These were the people who were covered under TDS. So TDS used to say that recipient, while making payment to the supplier, has to deduct TDS of 2%, and this 2% will be reflected in e-cash ledger of the supplier. This was the provision. Now they have added one more point here. Metal scrap between 2 registered persons. If both are registered, then TDS will apply on this, so that government can track these supplier, whether these suppliers are correctly declaring the sale of metal scrap and paying correct amount of tax on metal scrap. But if you recall, there was a point saying that amongst those who are required to deduct tax, TDS will not apply. Now in that point, one exclusion has been put, that is metal scrap. Because if you exclude metal scrap saying that amongst them no TDS, hey, here both are liable to deduct tax. So amongst them if you put, then TDS will never apply on metal scrap. Hence the exclusion of amongst them is metal scrap. That means metal scrap being dealt between these people is liable to TDS. Let's have a look at the provision. The notification relating to persons notified to deduct tax is amended to provide that any registered person receiving supplies of metal scrap from other registered person, so both have to be registered. If supplier is unregistered, then it will be a case, and recipient is registered, then it will be a case of RCM, shall deduct tax at source under section 51. It has been further provided that TDS shall be deducted by the recipient on supplies of metal scrap even when it is supplied between persons mentioned in the notification. That means between authority, board, society, local authority, government or PSU. So between them also it will be applicable. Okay, now coming to the changes of invoice, return and e-way bill. Return, one very important change has happened. GSTR 1A, a new form has been introduced. Now let me give you some background. GSTR 1, say suppose I talk about June 2025. What's the due date for GSTR 1? 11th July 25. Now once I have filed this GSTR 1, can I refile this GSTR 1? The answer is no. A return once filed cannot be refiled. Once you have filed June GSTR 1, you cannot refile it. But sir, say suppose I have missed out something, or there is an error, or there is an omission, then what do I do, sir? Then in that case, the next option was when you are filing July return in August, July GSTR 1 in August, there would be a place called as amendments. One would be normal, second one will be amendments. In this amendments, you could make changes, and once you make the changes in amendments, thereafter you could have easily gone ahead with the changes. But there was one problem. This I can do only in August, but I want to do these changes before filing my GSTR 3B for June, which is due on 20th July 2025. Now between these two periods, can I do something? Government has come up with an amendment that if you want to add some invoice or add some credit note or amend something which you have filed for GSTR 1, you can file GSTR 1A and change it before filing 3B. That means GSTR 1A is a very important change. You can rectify your GSTR 1 using GSTR 1A before filing GSTR 3B. Now let's understand between what period can you file GSTR 1A, and do you think it will be mandatory or optional? Obviously it is optional. And what can be the reason for which I will file GSTR 1A, and what is the period for adding or omitting, for adding anything which has been omitted or for changing the details which has gone wrong? Between what dates can I file GSTR 1A? From the date of filing GSTR 1 till the date of filing GSTR 3B. Between these two dates, date not due date, date of filing GSTR 1 till date of filing GSTR 3B, you can file GSTR 1A. Now sir, will my recipient also get communicated when I make some change in 1A? Yes. I mean, wherever GSTR 1 reference was there, government has also added GSTR 1A. Can 1A be used as a document for 2B generation? The answer is yes. But obviously, if you file 1A before 14th, then it will come in 14th. If you file 1A after 14th, then it will come in next month GSTR 2B of your recipient. But at least the good part about 1A is your 3B gets the correct figure. Otherwise, what used to happen, say suppose I have reported sales of 100, GST 18, Total 118. How much of tax should I pay in 3B? I should pay 18 rupees in 3B. Now, I missed out reporting one credit note. Credit note was of 90. Tax was 16.2. So, actual tax payable by me was 1.8. But if I miss out reporting credit note, then I'll have to pay 18. Otherwise, mismatch between 1 and 3B. And then I will receive a notice under DRC 1B. Difficult. And that's the reason this credit note can be added using GSTR 1A. And the moment you add this using GSTR 1A, you get a big relief. Your 3B figure will be 1.8 and not 18. So this is a very big advantage for GSTR 1A. Let's have a look at GSTR 1A provisions. Mark it as very important. Institute may test you on this. Provided that the person may, after furnishing details of outward supply in GSTR 1 for a tax period, but before filing GSTR 3B, at their own option, amend, add details of outward supply in GSTR 1A electronically through the common portal or facilitation center as notified by Commissioner. What's the purpose? Allows taxpayer to amend outward supplies filed in 1 for the current tax period. Optional nature, obviously. Scope of amendment, very wide. Everything can be amended. Impact on tax liability, yes, will affect the tax liability which is auto-populated in 3B for the same tax period. Availability of ITC to recipient, yes, ITC amended via GSTR 1A is reflected in recipient's 2B for subsequent tax period. 1A can only be amended electronically via GST portal or notified facilitation centers. Timeline for monthly GSTR 1A is available from the due date or actual date of filing until GSTR 3B is filed. For QRMP, 1A becomes available after the quarterly GSTR filing and is open up to 3B filing. No separate amendment facility exists for IFF records for first 2 months of a quarter. IFF month 1, month 2, you cannot revise it. If you file GSTR 1 later, then you can use 1A to amend IFF also. Changes in recipient's GSTIN must be rectified in subsequent tax periods GSTR 1. No due date, there is no fixed due date and it is up to the 3B due date. And it is optional. If there is no mistake, no need to file anything. Okay, if you recall, invoice-wise details was required for interstate supply to unregistered person. Earlier the limit was 2.5 lakh. Any invoice more than 2.5 lakh interstate B2C. B2C interstate more than 2.5 lakh was to be reported separately. Now this 2.5 lakh is changed to 1 lakh. So now any invoice of more than 1 lakh needs to be reported separately in GSTR 1. Sir, what about revised invoice? There also the limit of 2.5 lakh was there, that in case the amount is more than 2.5 lakh, separate revised invoice has to be issued. There, government has not made it 1 lakh. I think they have missed it out. So now there is a difference between the provision. Revised tax invoice talks about 2.5 lakh, but this talks about 1 lakh. So there's a difference between the two provisions, which you need to recall properly. Return reporting is 1 lakh. Revised tax invoice is even today 2.5 lakh. Okay. Due date for GSTR 4 is changed to 30th June after the financial year. Earlier it was 30th April. Now it is changed to 30th June. Then annual return filing has been exempted up to 2 crore for FY 23-24 as well, which was there for even earlier years. Now coming to refund amendments. Okay. One additional point has been added, that you can claim refund of additional IGST on upward revision of prices. What is upward revision of prices as per the agreement? Say suppose today I supply some exports at 100. GST charged on this 18. Total 118. I have charged IGST. Can I do export with payment of GST? This is only for with payment of GST, huh? Not for without GST under bond or LUT. With IGST, if I export 100, then can I claim this 18 rupees as refund? Yes. Refund eligible. Refund eligible. Now, say suppose there is an upward revision of prices. What is upward revision of prices? We had agreed that depending on future circumstances, there can be a 10% increase in this. So what happens? I will increase it by 10%. 10 rupees will be the increase. I will have to pay IGST because if there is upward revision, I will have to pay IGST because I have paid IGST on the main supply. Now I'll pay this through my GSTR 3B. Can I claim a refund of this again? Yes. Refund eligible. I have to make a separate application. This will not happen automatically. Now if you recall, export with IGST, this one happens directly once for goods. If there is a shipping bill, the moment I file shipping bill and give those details in my GSTR 1 and pay the taxes in 3B, automatically the money comes in my bank account. I don't have to file a separate refund application at all. But for this, I will have to file a separate refund application with so many details. Obviously, now if I want the refund of this 1.8, now there is no shipping bill because the goods have already gone. Later on, an upward revision of prices are happening. Then in that case, I have to file a separate refund application. One more point has been added for upward revision, that if there is downward revision, I will have to pay back that amount of refund, and obviously I can adjust it in my GSTR 1 and 3B using credit note. Clear with this? Yes. Let's see the documents required. That's important because they might ask you this question as a case study question for 5 marks. Refund application for additional IGST due to upward price revision. A new sub-rule 1B provides that refund of additional IGST paid due to upward price revision of goods after export with refund of IGST paid at the time of export. Refund application may be filed electronically using RFD01 within 2 years from relevant date whenever upward revision happens. Documentary evidence, export invoices copy, shipping bill or bill of export, BRC bank realization certificate or FIRC, details of refund sanctioned earlier, supplementary invoice or debit note which I would have issued for the upward revision, payment of proof of additional IGST in 1 and 3B I will pay it, additional FIRC for upward price revision and certificate from CA CMA. Contract or documents indicating price revision, too much sir. Reconciliation statement of supplementary invoice, debit note, credit note with relevant BRC or FIRC, bank reconciliation realization certificate or foreign inward remittance certificate. Okay, second one, it's a happy change for all of you. 894A, 894B has been completely omitted. Now this used to be excluded from net ITC. It used to get excluded from ZRS turnover of goods. It used to get excluded from aggregate turnover. Basically turnover for all the supplies. For these three cases, 894A, 894B supplies used to get excluded, like merchant exports, deemed export, they used to get excluded. Now that exclusion will not happen. Without removing anything, you can claim refund of ZRS. So 894A, 894B is omitted, no exclusion. So you'll find it in refund chapter. Please delete or strike off 894A, 894B from these three places. Okay, mechanism for refund of additional IGST for upward revision. Refund application for additional IGST, same, just a circular. Paid due to upward revision in prices of export goods must be filed electronically using GST RFD 01. Application is processed by jurisdictional GST officer. Processing of refund claims. The proper officer must verify that the exporter reported details in GSTR 1 and 3B, paid additional IGST with interest. Verification includes checking revised values and foreign exchange remittance. Issuance of refund, one RFD 06 will be issued, payment order RFD 05. Detailed order should be passed. If there is a downward revision, then he must deposit the excess IGST refund received in proportion to reduction of price along with interest. PO will verify deposit by the refund. Okay. Now, there is a new rule added, Rule 95B. This is for Canteen Stores Department. Now, Canteen Stores Department can claim a refund. Is it? Yes. Canteen Stores Department is under Ministry of Defense. Canteen Store Department, whatever they receive purchases, they can claim a refund of that. So, Canteen Stores Department can claim a refund of tax paid on inward supply for a quarter. This is similar to, you'll write, similar to UN or embassy. Whatever is the benefit available to UN or embassy. You remember, UN or embassy can claim within 2 years from end of the quarter in which the supplies were received. Same point is applicable for Canteen Stores Department. Whatever they have paid on purchases, they can claim a refund of that within 2 years from the end of the quarter. There are some conditions that the supplier who had supplied to them should have filed GSTR 1 and it is communicated to the person in GSTR 2B. So that condition is there. I mean, basically he should have paid the taxes in GSTR 3B. That's the whole aim. Thereafter, your Canteen Stores Department name and GST number should be entered. All these basic preliminary conditions are there. Otherwise, it is as good as the relief granted to UN or embassy. Let's read. A new Rule 95B specifies the procedure for Canteen Stores Department under Ministry of Defense to claim refund of taxes on inward supply of goods, overriding Rule 95. The rule states that Canteen Stores Department can claim refund of 50% of CGST, because we are reading CGST law. SGST, it depends on whether state governments agree. Paid on inward supply received for subsequent supply to unit run canteen or authorized customers under section 55. Refund application must be filed electronically in RFD 10A once every quarter and will be treated like application filed under RFD 01. Inward supply must be received from a registered person with tax invoice details furnished in GSTR 1 and supplier must have filed his 3B. He should have paid the taxes. Name and GSTR number of the applicant must be mentioned in the tax invoice. Goods must be received for subsequent supply to unit run canteen. It is for basically Canteen Store Department anyways does not consume it. It gives it to various units which are running canteen or authorized customers of Canteen Store Department. Okay. Then the next amendment is relating to Rule 96. Rule 96, they have added that additional IGST on upward price revision will be eligible. That's the only change. 96A, 96A, see what the rule 96A is basically LUT or bond. Now there were 2 points. If goods are to be exported, the goods should be exported within 3 months from the date of invoice. Otherwise, the taxpayer agrees to pay GST along with interest within 15 days. That's the undertaking which you take. For services, the undertaking was, if you don't receive foreign exchange within 1 year from the date of invoice, then within 15 days you will pay GST plus interest. Here it was from date of removal of goods, and here it was from date of invoice. I should receive foreign exchange within 1 year. Now what they have done, 1 year or time limit allowed under FEMA with extensions and subject to further extensions which may be granted, whichever is later. So if FEMA with extensions is granting 1.5 years, then will you consider 1 year or 1.5 year? 1.5 year. That's the only change. Let's read it. Amendment in Rule 96A. Export of goods or services under bond or letter of undertaking. Rule 96A. 1B. The registered person exporting services under bond or LUT must pay the tax due along with interest within 15 days after the expiry of 1 year or such further period as may be allowed by Commissioner. This is earlier one. From the invoice date, if payment is not received in convertible foreign currency or INR as permitted by RBI. This clause has been substituted to allow 15 days after expiry of 1 year or period allowed under FEMA, including extensions permitted by RBI, whichever is later from the invoice date, or such further period as may be allowed by the Commissioner. So this is the change which has happened in this case. Clear? Okay, now coming to the changes relating to assessment, adjudication, appeal and miscellaneous provision. One very important change is fixing of monetary limits. Now, see, there is a provision which fixes monetary limit. You had read this saying that the board has a power to set up limits, saying that if the amount is less than these limits, then don't file appeal, because the expenditure which you incur in filing the appeal is much higher than the recovery which you will make. Now finally CBIC has set up the limits. For first level appeal, GST 80, and GST 80 is yet to come, but 20 lakh. For High Court, 1 crore. For Supreme Court, 2 crore. If the order is below these limits, then please don't file an appeal. Now, there were issues. This 20 lakh is CGST, SGST or IGST? That was the first question. So, CBIC has given various clarifications saying that all these limits are taken to be, if the order is for tax with interest penalty, then all taxes needs to be considered for checking these limits, but not interest, etc. If it is only for interest, then only interest. If it is only for penalty, that only penalty. If it is only for late fee, then only late fee. If it is a composite order is where 2-3 notices, 1 order is passed. Oh, does that happen, sir? 2-3 notices, 1 order is passed. Then all the amounts of tax needs to be considered, or if it is interest, then interest, or if it is penalty, then all the penalty. But composite order, not for a single notice, it will include everything. Plus, say suppose there is something related to place of supply, which is an important matter, or classification related disputes which will have a recurring effect, or valuation related issues which will again have recurring effect, or something which is ultra vires to the constitution, saying that the provision is ultra vires to the constitution, then in some cases these monetary limits will not apply. Officer can go ahead and file an appeal. Sir, what if in some case it is more than these, but officer feels that it is not worth the appeal, then don't file it. It just doesn't mean that the moment it crosses these numbers you have to file an appeal as an officer. Below this, don't file. More than this, check whether we have a winning case. And if it is these matters, then go ahead and file it irrespective of whether it is below these limits or more than these limits. They have kept it very wide, people. I think officers can file it in any case, because place of supply, classification, valuation, exemption, which affect the amount, or board can give further direction. So it's a very, very wide and open-ended circular. Let's have a look. Mark it as important, they can ask you this. Okay. You had read this in appeal chapter. Fixing of monetary limit for filing appeals or applications by department before GST, High Court, Supreme Court. Following monetary limits have been fixed for filing appeal or application or special leave petition, as the case may be, by central tax officers. Oh, that means state can still, sir. Yes. Before GST, Appellate Tribunal, High Court, Supreme Court. GST Appellate Tribunal 20 lakh, High Court 1 crore, Supreme Court 2 crores. If tax dispute is with or without penalty interest, then only aggregate of tax. This is important. If it's an interest dispute, only interest. Penalty dispute, penalty. Late fee dispute, late fee. Interest, penalty, late fee without tax, then aggregate of interest, penalty, late fee. Erroneous refund, then the refund amount, but all the taxes taken together. Composite order for one or more notices, total amount in all demands, not just individual appeal or notice. General rule, apply on the disputed amount only. Say suppose partially the officer agrees to it, then whatever is the disputed amount, based on that you'll apply the limits. Exclusions, monetary limits don't apply in cases involving constitutionality, ultra vires ruling, valuation, classification, refund, place of supply. Now this is a separate part. Valuation, classification, refund, place of supply, which is recurring in nature or involves interpretation of provisions. I mean, everything involves interpretation of provisions only. Or significant government interest, again very open-ended language. Or any other case or class of cases where board is of the opinion that it is necessary to contest it in the interest of justice or revenue. Very, very open-ended. Okay. Anyways, we have to read it for examination purpose. Then rule 110, completely modified. Appeal to appellate tribunal. How will the process work? Now all that is defined. It is similar to first level appeal, that say suppose the order is uploaded online, then you file the appeal online, provisional acknowledgement will be given. If order is available, whatever is the date of provisional acknowledgement, that will be the date of final acknowledgement, and that will be the date of filing appeal. If order is not uploaded, then submit a self-certified copy within 7 days. If you submit it within 7 days, provisional acknowledgement date will be considered as date of appeal. If you submit late, then whenever you submit, that will be considered as date of filing appeal. Such points have been added. Okay. Same thing applies for department appeal. Also, cross objections, it has to be filed with the registrar. Such points have been added. Filing of appeals. Appeals under section 112(1) must be filed electronically in form APL 05 with relevant documents. Provisional acknowledgement will be issued immediately. Should we remember the form numbers, sir? To my understanding, even if you are not able to recall the form numbers, just write it is an appeal. That's sufficient. Manual filing is allowed only if registrar issues special or general order subject to conditions. Cross objections. Cross objection. Memorandum of cross objection is where I have filed an appeal. It gets communicated to department. Department says I also want to appeal. Then they will file a memorandum of cross objection. Must be filed electronically in APL 06. Manual is allowed only when registered. Acknowledgement. This is similar to your first level appeal. If the order is uploaded on the common portal, A final acknowledgement will be issued after removing any defects. Date of provisional acknowledgement will be the date of filing. If order is not uploaded online, self-certified copy should be submitted or uploaded within 7 days of filing APL 05. Final acknowledgement will be issued on defect removal with the provisional acknowledgement date as filing date. Whatever is the provisional acknowledgement date, that will be the filing date. If copy is submitted late, the filing date will be date of submission. The appeal is considered to be filed only when final acknowledgement is issued. Fees 1000 for every 1 lakh of tax credit penalty involved. Maximum 25,000 rupees. Minimum 5,000 rupees. For something which is not involving tax interest penalty fee, any other amount like disputes relating to compounding amount, that can come here. Then it will be 5,000 rupees. Plus it can also be anti-profiteering, because that is another point which has been added for appellate tribunal. No fee for application for rectification of errors. Then rule 111A, application to appellate tribunal. This is department appeal. Same points are there. Filing application under 112.3 must be filed in APL 07 with relevant documents. Provisional acknowledgement will be issued immediately. Manual filing again depends on the registrar. Cross objection, same way it can be filed. Acknowledgement, same way, only when final acknowledgement is issued. Same points, nothing. Withdrawal of appeal, mark it as important. Withdrawal of appeal, can you withdraw the appeal? The answer is yes. Withdrawal of appeal is permitted, but basically if you withdraw the appeal before issuance of order only, then it is permitted. If appellate tribunal has given the order, then you cannot withdraw the appeal. Plus, after final acknowledgement, you can withdraw only when tribunal decides it within 15 days. Because once final acknowledgement is done, that is now appeal. Can we file a new appeal, sir? Yeah, for new appeal again you will have to see the time limits of filing the appeal. Okay. Then section 109 read with 177. 109 is being amended to empower government to notify types of cases that shall be heard only by principal bench. The place of supply matter is heard only by principal bench. Plus, government can notify other matters which will be heard by principal bench. Using this power, central government has notified principal bench of appellate tribunal to hear cases with effect from 110. What is that case? Anti-profiteering cases shall be examined or adjudicated by principal bench. Careful. Appeal is different. Examination and adjudication is different. Principal bench will also be responsible to examine or adjudicate a matter of anti-profiteering. Competition Commission of India will stop receiving any complaint on anti-profiteering with effect from 1/4/2025. Let's see. The government, based on council recommendation, may announce a date from which concerned authority will stop accepting requests. Concerned authority is Competition Commission of India. To check whether the benefit of ITC or tax rate reduction has been passed on the customers through lower prices. Using this power, government has notified 1/4/2025 as the date from which authority will not accept any request for examination under this provision. So there is a sunset clause brought. Request for examination means a written application submitted to verify if the registered person has reduced prices appropriately after availing ITC or benefiting from reduction of tax rate. For anti-profiteering provisions, authority will include appellate authority. So appellate tribunal hear matters of anti-profiteering? Yes. And from 1/4/2025, anyways, the power to examine anything will be taken away. Clear with this? Yes. So CCI is empowered, appellate tribunal principal bench is also empowered to hear cases of anti-profiteering. Okay, now let's see the circular. This circular I did not expect institute to keep, but it is being kept in your May 25 module, so we will learn it. Now see, let me give you some background. First appeal, 10% pre-deposit. Second appeal, additional 20% pre-deposit. Now the problem was first appeal to appellate authority, second appeal to appellate tribunal. Tribunal has not yet come into existence. So people were saying that tribunal has to come, then only we will make this 20% deposit. Now how do we make this 20% deposit? Now we want to file the appeal. Department used to initiate recovery proceedings. Now as department used to initiate recovery proceedings, it was becoming very difficult because I wanted to file an appeal, but department has initiated recovery proceedings. Now one circular has been issued that if you deposit additional 20%, there's a separate mechanism. Go to payment section on the portal and deposit this money. If you deposit this 20% additional, then there will be a stay granted from recovery of balance 70%. So if a person has lost a case in first level and he wants to file an appeal in second level, then he has to deposit this 20%. Once he deposits this 20%, then no recovery will happen until and unless the tribunal comes into existence and his case is heard. Let's see. Clarification on recovery proceedings and pre-deposit for appeal. Appeal filing and recovery stay. As per 112.8, filing of appeal with prescribed pre-deposit automatically stays recovery proceedings for balance amount under 112.9. Due to unavailability of tribunal, taxpayer could not file appeal or make pre-deposit, leading to disputes about recovery stays. Clarification on pre-deposit payment. Taxpayer can pay pre-deposit amount by navigating to Services Ledger Payment Towards Demand. The amount will be adjusted as pre-deposit when filing appeal before appellate tribunal. Upon payment of pre-deposit and filing and undertaking a declaration with the officer to file an appeal when tribunal becomes operational, recovery of remaining demand is stayed. Adjustments for full amount. Taxpayer who have already paid the full amount can file application electronically on the portal to adjust the payment towards pre-deposit. Until portal functionality is live, taxpayer should intimate the proper officer who will then defer the recovery. This clarification ensures recovery proceedings are in line with taxpayer's intent to appeal and provides a structured mechanism to manage pre-deposit and recovery related concern. So this is a good step, but you'll have to make additional 20% pre-deposit. Okay, offences and penalties. Offences and penalties, 122A penalty has been added, but ICI module does not have it, so we are not going to deal with it. This is for pan masala machines. A separate procedure has been kept, and if they don't follow that, then the penalty has been kept. Okay, coming to changes in customs and FTP. Customs and FTP, additional points and changes. Protective duty is omitted. Section 6 and 7. See, safeguard duty is still there. Anti-dumping duty is still there. CVD on subsidized goods is still there. What is deleted is protective duty. There used to be a topic called as protective duty. Now it's not there in syllabus. So you can delete protective duty provision section 6. Then all machinery provisions, that is rate of duty, assessment, non-levy, short levy, refund, exemption, interest, recovery, appeal, offences, penalty will apply to all the three. Anti-dumping duty, CVD on subsidized goods, and safeguard duty. That was anyways held by the courts, but now it is included in the law. Does it impact us, sir? No. Then time limit for re-importation of goods has been increased from 3 years to 5 years. Under section 20, re-importation where say suppose you re-import the goods, you export it, then you re-import the goods. You remember, if you re-import the goods, custom duty is applicable because charging section is already triggered, but custom duty is restricted to export benefit claimed. Whatever is the export benefit claimed, that will be the custom duty payable. Correct? This was the provision. Now, here the time limit was 3 years. Now that 3 years has been extended to 5 years. Plus, there could have been an extension of 2 years. That extension remains as it is. So, total becomes 5 plus 2, 7 years. Same way, you remember when you re-import after repair, there was a point re-import after repair. Now if you re-import after repair, then you have to pay fair cost of repair plus material cost plus to and fro freight and insurance. Now the provision is same, to and fro freight and insurance, everything remains same. Here also 3 years have now been changed to 5 years plus 2 years extension remains same. That means total has become 7 years. So in case of re-importation, they have made two changes, section 20 and this is section 25B. So these are the two changes which have happened. Let's see. Time limit for re-importation of goods under section 20, 3 to 5 years, additional 2 years remains same. Time limit for re-importation of goods under 25B, read with notification 45/2017, is also increased from 3 to 5. 2 years extension remains same. So extension has not changed, only the main time limit of 3 has been enhanced to 5. Okay. Then duty credit scrip under RODTEP. You remember RODTEP? Remission of duties and taxes on export product. So any central excise, VAT, etc. which you would have paid, government gives it in the form of duty credit scrip as a percentage of FOB with a value cap. That was not available to SEZ. This was not available to EOU. This was not available to BTP. This was not available to EHTP. This was not available to exports under advance authorization. It was not available to DFIA. It was not available to EPCG. But the problem is, these are the major exporters. If you don't give it to the major exporters itself, what's the use? Now, government has deleted them from exclusion. Now please understand, deleted them from exclusion. That means all these will now be eligible for RODTEP. But remember one thing, they will not get it for deemed exports. They will get it only for physical exports. Let's see. Earlier, duty credit scripts for products manufactured by EHTP, BTP, EOU, SEZ, Free Trade Zone, Export Processing Zone, products manufactured or exported in discharge of export obligation under advance authorization, DFIA, EPCG were not allowed. Now, both the above provisions have been deleted to allow duty credit scrip in the aforementioned cases, because they also use petrol, right? They should also be eligible. Okay. Then one small change has been made. Import of second hand IT goods from SEZ to DTA is now restricted. second-hand information technology goods, second-hand laptop, second-hand computer, second-hand printer from SEZ to DTA is restricted, meaning now you require a authorization or a license. That's it. One authorization or license is required because lot of electronic waste was coming from SEZ to DTA. Now to put a bar, they have said license required, only then we will allow. Earlier it was free. Free meaning not duty free. Free meaning allowed without a authorization. Now it is restricted, meaning now it requires a authorization. Okay. Merchant trading carried out within one specific foreign country is now permitted. See, what is merchant trading? Merchant trading is basically a person sitting in India gets goods from US delivered to Sri Lanka. This is called as merchant trading, where it does not come into India, but it goes from US to Sri Lanka. This was already allowed. Now, an Indian, can he sell between two places in US only and without goods coming into India? Yes, this is also allowed. Merchant trading within a single foreign country is also allowed. Sir, can Indians do this? Yes, they do it. They are able to communicate well between two people. They order the goods from one place in US. The other place in US has a requirement. They get it shipped there and earn profit. Oh, is it, sir? Is it allowed under FTP now? Yes. Let's see. Earlier, merchanting trade of shipment of goods from one country to another country without touching Indian ports involving Indian intermediary was allowed, subject to RBI guidelines except for goods of cities and SCOMAT, some specific endangered species, or SCOMAT is special chemical organism material equipment technology. Now, merchant trading carried out within one specific foreign country is also permitted except cities and SCOMAT list. Okay, coming to the last change, that is import of items under advance authorization EOU SEZ is enabled without compliance of mandatory quality control orders. Now, this BIS, ISO, these organizations issue standards. Now, these standards are for maintaining quality of products which are being imported. So, every product had to undergo this mandatory quality control orders. Now government has given a relief that something which is imported by advance authorization holder, EOU, SEZ, need not go through this mandatory quality control order, provided that the material which is imported by them, the material imported is exported. Material which is imported by them is exported. It should not be supplied in DTA. If it is exported, if product, then the import of items under advance authorization etc. is allowed without this mandatory quality control order. Let's see. If you read first one, advance authorization, then the language is similar for EOU and SEZ, that it should be physically exported outside India. Quality control orders are regulatory mandates issued by Indian government to ensure products meet specific quality standards. These orders are typically issued by BIS under BIS Act with apply to a wide range of products to protect consumer safety, health, environment. Domestic manufacturers as well as importers needs to ensure that products covered by quality control orders must not be manufactured or imported without compliance of specific standards. Enabling provision have been incorporated in FTP for exempting inputs imported under advance authorization EOU SEZ from mandatory quality control orders. However, import of inputs under advance authorization EOU SEZ without compliance of QCO shall be subject to following conditions. Let's see. For advance authorization, import of inputs under advance authorization without compliance to mandatory QCOs shall be with pre-import condition. What is this pre-import condition? From the same input you should make finished goods, and that finished goods should be exported outside India. Such inputs shall be utilized in manufacturing of export product. You should use it only for manufacturing export product. Normal allowance for wastage is allowed. Shall be exported under same authorization. Unutilized imports shall not be transferred to DTA even after regularization of default in fulfillment of export obligation. You cannot sell it to India. It shall be destroyed in the presence of jurisdictional GST or custom authorities, or may be re-exported. In addition, such unutilized import shall be liable to pay effective duty along with interest, that is obviously, plus composition fee to DGFT. There is a compounding fee which is called as composition fee. Said exemption shall be specifically endorsed in the advance authorization. It should be written in the advance authorization. So while taking advance authorization, you should get it from the department upon request from the authorization holder. The exemption for QCO will be available for physical exports only, and such exemption will not be allowed for deemed export for advance authorization holders. Import of inputs without compliance to mandatory QCO under DFIA scheme is not allowed. DFIA will not get this. EOU, same point repeated. EOU exemption from QCO under BIS Act shall be provided to EOU on import of inputs which are required for export production. No DTA clearance. That's the main thing. Of such inputs or goods manufactured out of such inputs are allowed. An undertaking to that effect will be submitted to the custom authorities by the EOU at the time of importation. Copy of the same will be submitted to Development Commissioner of the EOU. Exemption from QCO will be available only for physical exports and will not be allowed for deemed exports. Same point is repeated for SEZ. Okay. Above exemption shall be applicable only for list of notified ministries or departments whose notifications on mandatory QCO are exempted by DGFT, or goods utilized or consumed in manufacture of export product. That ministry has to give the approval. That will automatically happen, because if government is intending to give an exemptions, ministries will also work in tandem with what is the requirement of the industry. So basically this is a benefit for EOU. They don't have to go through that mandatory quality control orders. Clear with this? So these were the amendments for your examination May 25. Wishing you all the best for your